Hey guys, Q here from Ayanti Trading, and welcome to your first lesson here with us about options. We're going to go ahead and get started with the easy stuff and move on to the harder stuff as we go. In the first chapter, we're going to be talking about what an options contract is, some key concepts, vocabulary, and some analogies that will help you understand the full concept. So let's go ahead and get started with the definition. An options contract is defined as the agreement between two parties, one buyer and one seller, for the sale or purchase of 100 shares of a company's stock. So every one contract equals 100 shares of a company's stock. Once entered in a contract, the buyer has the right to purchase the stock and the seller has the obligation to sell in the future to the buyer. The 100 shares are not actually owned by either party until the contract is executed. So when you're trading an options contract, you're only trading the value of the contract, not the actual stock itself. But the underlying stock's price can dictate the premium price of the option, and we'll explain what that is in the later chapters. So let's use an analogy to help you understand what an options contract is, but we'll do it without using stocks in the beginning, and then we'll move into what an actual stock analogy looks like. So let's say there's a car right here, and this car is right now worth $5,000. And you as a buyer want to buy this car because you know that it's going to go up in value in the future. But you don't want to buy it just yet. So there's another person on the other side that's telling you that, hey, I'll tell you what. Let's get into this contract and I will guarantee you that you can buy this car at $7,000. Although it's worth $5,000 right now, I'll sell you this car at $7,000 even if it's trading at $10,000 in the future. But this doesn't come for free. The buyer must pay the seller some kind of premium for giving him that offer. So now we have a buyer on one side and we have a seller on the other. And the buyer and the seller agree that by 2021, this car is going to be worth $7,000. So the buyer tells the seller, okay, I'll give you $100 so I can guarantee that I can buy this car at $7,000 even if it's worth $10,000 in the future. So now anytime between now and 2021, if the car reaches a price over $7,000 in market value, the buyer can execute this option and purchase the car, and now he owns the car for $7,000 although it's worth $10,000. So, once again, the buyer pays the seller some kind of premium fee for allowing him to get into this contract and giving him the option, there goes the name, the option to buy the car at $7,000 even if it's worth more in the future. But say worst case scenario, they enter this contract and the buyer assumes that this car will reach $7,000 by 2021, but it never does. It stays under $7,000. What does that mean for the buyer? That means the buyer just lost his $100 and the seller gained the full $100, and the car was never sold because the buyer never executed. At any point between now and 2021, the buyer can actually execute the contract and buy the car for $7,000. But that only makes sense if the car is actually worth more than $7,000, because the whole point for the buyer is to purchase the car at $7,000 and resell at the higher price that it's currently market valued at. If the car only reaches $6,000 by 2021, that means the buyer shouldn't buy this car because he can easily just buy it at market value for $6,000 without having to go through the contract. But if the car reaches $8,000, now the buyer can buy the car at $7,000 and resell at $8,000 at any given time, as long as he does so before 2021. The timeline of an options contract is very important. The timeline for the buyer is actually working against him, because every day that you get closer to that expiration date, this options contract is getting less and less valuable if it's not reaching towards the $7,000. But we'll explain what that is in the later chapters, because it's going to get a little hectic for you if we start off with that right now. So let's clear this chart up and actually move into an example of actual stock Hopefully you can base it back on this analogy and kind of understand what's going on. So let's move on to buyer position versus seller position and what's in it for both parties. In the buyer position, the buyer of an options contract gets the right to buy the stock in the future at a strike price that he sets. So, going back to the car analogy, remember how we said that the car is currently valued at $5,000 and the buyer wants to buy at $7,000? The $7,000 would be considered the strike price. Let's move on and try to explain that in this little graph right over here. Say you're looking at the stock chart, and right now the strike price that you're setting is $20. Currently, the price of the stock is $10, but you're hoping that by March 1st, based on patterns and different indicators that you're seeing, that by March 1st, the stock price is actually going to be $20 or greater than $20, and you want to guarantee an option to buy the stock at $20 no matter where it's trading at in the future. So what you can do is you can enter an options contract with a seller to guarantee that by March 1st, if the stock goes above $20, you can buy 100 shares of this company at $20, even if it's trading at $30. So now you're kind of seeing how this is beneficial for the buyer. If one options contract is worth 100 shares, and it always is, 99% of the time an options contract is worth 100 shares. Now, as the buyer position, you are guaranteed 100 shares at $20, even if the stock is now valued at $30, and you can buy as long as you do it before March 1st. So if now you have 100 shares times 20 and you just bought all these shares for $2,000, that means you just profited $1,000 right off the bat because you had the option to buy at 20, although the stock is trading at 30, as long as you execute before March 1st. Now, at any given time, you can actually execute. So if it's February 5th and the stock is trading at 25, you can go ahead and go through with the contract, buy the stock at 25, buy the stock at 20 and resell at 25 for that profit. But at Ayanti Trading, and we'll explain that in the later chapters, we never actually execute the contract. What we make money on is the actual premium price of the contract, because every contract has a value to it. And as the stock price goes up towards and past the strike price, the contract value goes up. So let's say you paid $50 to enter this contract value and the stock had moved up from $10 to $20, your contract value is likely to be $200. And there you go. You can sell this contract now and make that $150 profit without having to spend $2,000 to buy the stock itself. And that'll make more sense in the later slides as we go through the buying and selling positions of the contract at Ayanti Trading. So let's take a look at the seller's position. So if the buyer is making this profit, what is in it for the seller, or how does the seller make his profit? The seller is making profit from the premium. So option contracts are not free. We just talked about that. You have to pay the seller some kind of compensation. You have to give them some kind of premium fee for providing that guaranteed position in the stock at that strike price. Their main goal is to collect the premium of the cost of the option that they are offering. And the way they collect the full premium is if the option stays below the strike price. So if they give you the option to buy the stock at $20 and the stock never reaches $20 and it stays above this, and you paid them $50 for this contract, that means they will collect your full $50 and they will walk away with that profit. However, the seller starts to lose money as soon as the stock reaches 20 and goes above it. That's when they start chipping into their profits, because they no longer are making profits off of you because the stock is starting to go above that price that you guys had agreed upon. So the seller is praying and hoping that the strike price is never actually achieved. That way they can collect their full $50. So if the buyer agrees that he will buy the stock at $20 and now the stock is trading at $22 and he would like to execute his contract, Executing means that he is now going to buy those 100 shares. He's actually going to exercise that contract. He's actually going through with the option to buy the stock at 20, and the stock is valued at 22. Therefore, he makes that $2 profit per stock of the 100 shares that he now owns. So how do we make profit as buyers in the options contract? So let's say here we have a chart and we paid $100 to the seller as buyers. This is negative because this is the amount of premium that you pay to the buyer. Remember, every options contract has a premium price, so it's not free. You don't just get to tell someone like, hey, guarantee me this stock at this price no matter what. You actually have to pay some kind of premium for that. And so if you pay premium when the stock is trading at this actual price of $100, your goal is for the stock to go up towards the strike price that you guys had agreed upon. And as the stock goes up towards that strike price, that means the options contract is going to be more and more valuable as the strike price gets more and more achieved. So now, as you can see, the stock price has reached that strike price and the contract price has also gone up in value. Therefore, you can just simply resell your contract and make that profit. Here we went from negative 100 to positive 200, so we actually made $200 on this trade in this example. But there is always one thing that's working against us as buyers, and that is time. There's a huge difference between trading stocks and trading options. Options move very quickly. Options also have an expiration period. Every day that we move towards that expiration period, the option contract gets less and less valuable. So although the stock may be moving up towards that strike price, if the expiration is March 1st and now we're at February 5th or February 25th, that means the option has lost some of its value due to time decay. So option buyers have one thing that's always working against them, and that's time. Therefore, you have to set out a specific time for you to give yourself enough chance for the stock to swing in the direction that you favor. So if you are giving yourself 1 week and you're expecting the stock to go from $10 to $30, you're likely going to lose money on that trade. However, if you're giving yourself 2 months and you're expecting the stock to move up $5, then you're probably going to make some money on that trade because that's enough time as long as the stock is moving in a bullish position. Alright, so in this next section, I'm going to break down buy to open and sell to close versus sell to open and buy to close. Right off the bat, I want to point out that buy to open and sell to close will belong to the buyers. So if you're on the buying side, then you would normally buy to open a position. So you would pay the seller, which is going to be at the bottom right over here. You're going to be paying the seller some kind of money for you to open that position with them. And for them to give you that contract, they pretty much have to sell you on it. So the bottom side of this PowerPoint would be considered the seller. So the seller would sell you that position to open it while you buy to open it. So you pay the seller some kind of fee, which is the premium usually, to open that position. And then when you're ready to close out of that contract, then you're going to sell to close, and the buyer, or the seller in this case, is going to buy to close. So the buyer sells back the position and the seller buys it. So under no condition are you ever buying and selling from the same seller. I'm sure it's in a 1 in a million chance. This is just something that the market automatically does for you. So when you put in your request to buy to open, you automatically get fulfilled. If there's enough volume and open interest, you automatically get fulfilled the buy to open. And then say perhaps you paid, let's say you paid $10 to open that position or to open that contract. The seller then receives that $10 from you, and what you hope for is that your option contract becomes more valuable in the future. So let's say in the future your option contract goes up to $15, then what you would do is you sell to close at $15 and you make a $5 profit. Where does the seller get paid out? The seller hopes that your option contract does not indeed make profit and it goes down in price. Therefore, what he wants to do is he wants to sell back that position or buy back that position for less than what you paid for it. So to make that into an example, let's say you bought a position at $10 and then in this case the seller received this $10 from you, what he wants or what she wants is for the contract to actually go down in value. They want it to move away from your strike price, and let's say it goes down to $8. In that case, then the seller has the right, or he can buy to close, and he will make that $2 profit because he bought back the contract for less than what he sold it for. But again, don't get too confused about these two terms. I'm just showing you how they're going to look on your brokerage platform. It's pretty simple, really. Buy to open and sell to close, you're the buyer. Sell to open and buy to close, you're the seller. So you're selling to open the position, and then you're buying back the position, hopefully for a lower rate. Hey guys, Q again. Today we're going to talk about Chapter 2, which includes exercise and assignment of options and naked and covered options. This is fairly an explanatory chapter, so we're not going to be going into the technicals too much, but I would like to explain what exercise and assignment means because they're pretty critical for you as an option trader. So without further ado, let's go ahead and get started with contract exercise. What happens when someone decides to exercise a contract, or what does it even mean to exercise a contract? We've already explained that there are two sides to an option contract, which is one buyer and one seller. Now, at any time, the buyer has the right to exercise their option to buy the shares of the underlying stock. When the buyer exercises their option, all 100 shares must be bought at the strike price agreed upon. So remember, there are two sides to an option contract, one buyer and one seller, and there is a total of 100 shares in question. One option contract equals 100 shares. Therefore, when a buyer buys an option to buy 100 shares, at any moment in time, he can choose to exercise that contract, and he will receive 100 shares of that stock at the agreed strike price. That's the entire idea behind option contracts. What the buyer is doing is he is guaranteeing himself that stock at a specific price no matter where it's at in the future. And the seller is guaranteeing the buyer that he will receive 100 shares of that stock when he decides to exercise that contract. So I'm going to give you an example to how this works. Say you have one contract for AMD stock at $26. So your strike price for AMD is at $26 currently. This is what you purchased the contract for. You bought a contract of AMD, a call option contract, at $26. And now AMD is trading at $28. So your contract is actually valuable because you're guaranteeing yourself a $2 profit per stock out of 100 because one contract equals 100 shares. So now you can choose to exercise that contract at any time. If you exercise the contract today, there's a seller on the other side who guaranteed you 100 shares of AMD at 26 because that was the contract you guys agreed upon. So now you pay $2,600 and receive 100 shares of AMD, and you're already profiting $2 per share because AMD's current stock price is actually at 28. So now you're starting to see the value of option contracts. This is the value of them. The fact that you're guaranteeing yourself a stock at a certain price no matter where it's trading in the future. Now, if AMD was trading at $25, obviously it wouldn't make sense to exercise this contract option because you can simply go and buy 100 shares of AMD at 25 in the market rather than having to exercise your option. So if this is one side, if you are exercising the contract option as a buyer, what's happening to the seller? So the seller, on the other hand, gets assigned the contract. So he's not exercising the contract. The buyer exercises and the seller gets assigned randomly. So this is all random. The market picks this randomly. You're not guaranteed to be assigned when a buyer exercises. It just randomly happens. And if you get chosen for the assignment, then you must fulfill 100 shares as a seller. So the seller, on the other hand, is obligated because he got into this contract to provide 100 shares of the stock no matter where it's trading at because he had been assigned that contract. So now you're probably asking yourself the question, if I'm a contract seller and I get assigned a contract, how am I going to fulfill 100 shares? Which leads us to our next point, which is explaining the difference between covered calls and naked calls. So, Covered contracts are contracts in which the seller already owns 100 shares of the specific stock in which the option is being traded upon. So if you're a seller and you already own 100 shares of AMD, and then you get assigned a contract, then you can already deliver your 100 pre-owned shares to the buyer, no problem. So you're covered. So this is pretty much insured contracts. You're covered to fulfill in case you get assigned. However, if you have naked contracts, that's a lot more risky. So if you're selling a contract and you don't own 100 shares of that stock already, then you're putting yourself at risk because you will get assigned that contract. In case you do get assigned that contract, now you must fulfill 100 shares and you'll probably put yourself in a little bit of debt because you did not have those 100 shares already in your account. So selling contracts can be very risky if you're selling naked contracts. Now, this is not to deter you away from selling contracts because many of our future exercises and future strategies will include both buying and selling contracts. But just know that if you hold an option towards the expiration date, and we'll explain all this in detail later on in the chapters, if you hold an option towards expiration date and the closer you get to expiration, the closer you are to getting assigned. So it's more dangerous to hold a contract near the expiration date if you are a seller, because then at any point you can get assigned. This will all make a lot more sense as we're explaining options further when we get into expiration dates and types of assignments and types of different strategies. However, just want you to understand right now the difference between covered calls and naked contracts, because they can be very risky if you don't know what you're doing. So please guys, I encourage you to finish the entire course before you actually get into trading, because you don't want to get caught in a moment in which you have a naked contract and then you get assigned and now you have to fulfill 100 shares that you don't have enough money to fulfill. By the way, just a random fact, this is all regulated by the OCC. They make sure that everything gets exercised properly and they make sure all 100 shares are delivered properly at a proper time. But anyways, I just want to go over this chapter one more time. We started the chapter talking about contract exercise, which is the buyer having the right to exercise their option to buy the 100 shares that they had originally paid the seller for. Let me repeat that. So as a buyer, you're paying the seller to hold 100 shares at a specific price. At any point, you can choose to exercise that contract and collect those 100 shares. Remember, when you're buying an option contract, you're not buying the shares just yet. You just have the option, no pun intended, to buy those 100 shares at the strike upon price at any given moment that you choose to. And then contract assignment is when the seller gets assigned those 100 shares and he must deliver at the strike price agreed upon. Now, do we exercise our contract at Ayanti Trading? Not necessarily, and we'll show you why in the future, but just know it's extremely costly most of the time to exercise a contract on a very expensive stock. That's why we trade options, because we want to be able to work with a small account but still have large returns. This will make more sense when we show you more strategies. And then we talked about covered and naked option contracts. I said covered calls and naked calls here. Calls are just a type of option trade. We'll talk about calls and puts in our next, I believe, in the chapter 4. So in chapter 4, we'll explain the difference between calls and puts. But just know that when we talk about covered and naked, we just refer to the contracts themselves being covered, having 100 shares already in stock. And then naked means that you don't own 100 shares as a seller. So you're going in a more risky position. But anyways, that brings us to the end of chapter 2. If you guys have any questions, please reach out to us on social media or on our website if you can find our contact, or through email at ayantitrading@gmail.com. So we'll go ahead and see you guys in chapter 3, where we'll be covering stock trading versus option trading and the difference between the two. Hey guys, Q here from Ayanti Trading. We're in chapter 3. If you are still a little confused, don't worry. We're going to have a lot of examples of everything we've talked about that's going to really break things down for you on actual graphs. Right now, we're just going through the PowerPoint because it's important to understand definitions and the basics before we jump into actual trading. So here in this chapter, we're going to talk about the differences between stock trading and options trading and why we at Ayanti prefer options trading to make more profit with less risk capital. So let's go ahead and start with this little graph right over here. On the left side is a stock price graph. On the right side is an options contract based on the stock's price graph. So as you can see, the first thing at the bottom, we have time till expiration on the options contract. Remember that every contract has an expiration point, and that expiration point is the point at which you, as the buyer, want the strike price to be achieved before. So if you set a strike price for the stock at $110, you want the stock to achieve that $110 before the actual expiration happens, or else your contract will expire worthless. And so let's say the stock is currently trading at $100 and you bought an options contract for $50 on this stock. You said that I will pay $50 right now for me to be able to buy the stock in the future at 110, even if it's trading at 120. So you came into this contract and now you have the option in the future to buy the stock at 110 because that's the strike price that you set. You set this as the strike price. This right here line represents the strike price that you put between you and the seller for you to be guaranteed to buy this stock at 110 no matter where it's trading at in the future. So with that being said, as the stock moved up towards that strike price, you can see clearly on the right side that the options contract became more and more valuable. Now, these are not actual numbers from an actual trade. These are just kind of made up numbers, but it works kind of in the same way, just not the exact numbers. Say the stock moved from $100, which is the time of the purchase of the contract, and now it's trading at $110. If you had only been trading the stock, you would have paid $100 to make $10 on that actual trade. So you paid $100 for the stock and you resold at 110 as a normal day trader or swing trader would, and you made 10 bucks. Look at the options side, however. If you bought an options contract for $50, usually options contracts can be very cheap or very expensive. We'll talk about what sets the different premium pricing in the future. But say you bought an options contract at 50 and now the stock is trading at 110. Look at the value of your options contract. Now the value of your options contract has gone up to $90. You just made $40. You can sell this options contract at any time. You just made $40 because of this $10 move on the stock price. So you bought an options contract for 50. You resold at 90. Now you made 40 bucks. For you to do that with the same stock, you would have to buy $400 worth of stock. So you're risking a lot more money. And then you could sell at 110. That way you can make $40. So if you multiply this by 4, you pay $400 for the stock. You resell at $450. Here you only risked $50 of your account. Here you risked $400 of your account. Remember that you made $40 because the stock had gone up $10. This is the value of an options contract. Option contracts multiply exponentially as the stock moves up towards that strike price. However, there's always one thing that's working against you, and that's time, because the value of the options contract will actually start to deteriorate over time. Although, even if the strike price is achieved, the options contract will have some kind of value, which is called intrinsic value, and we'll go ahead and go into that in the later chapters. However, time is making it decay more and more as that date of expiration approaches. Again, let's go ahead and look at some of the variables in between the differences between stocks and options. If the stock is trading currently at 100 and you bought a call for $50, you bought an options contract that you are willing to buy the stock at 110. That's the strike price that you set. And the stock is now trading at 110. Your options contract will become a lot more valuable because that strike price is achieved. You just made $40 from a $50 investment rather than risking $400 to make $40. So it's pretty clear the benefits of options contracts, but it is very much recommended that you start trading stocks before you trade options, because with options, the money is moving a lot faster. It's not as easy to get in and out of trades because the movement of the money is happening at such a fast pace, and there's an expiration date. If you make a bad call on an actual stock, that means you can just hold the stock and wait for it to bounce back up if you are trading a reputable company. With options, if you make a bad call and that expiration date is starting to approach, then you can very much lose your $50. So there is a little bit of risk of trading options. If you're not familiar with day trading stocks or swing trading stocks, ask about our day trading course. It is actually available on our website. And you can actually buy a bundle with this course. If you've already purchased this course and you need a day trading course, hit us up, let us know, and we'll give you a great price on our day trading course. Now, let's go ahead and compare a little bit more of options trading versus stocks trading. Some options pros: it is a small amount of capital that's required, an exponential profit potential, and penny stocks versus recognized stocks. We'll get into this in a little bit. Option cons: it's high risk because of that expiration date. That means you're risking a lot of money sometimes because that expiration date is starting to approach and the stock hasn't swung in your direction. So if the expiration date approaches, the stock is nowhere near that strike price that you set, that means you're going to lose the premium that you paid. But you are only required to invest a small amount of capital for you to actually make profit. As I showed you in this example, you risk 50 to make 40 rather than risking 400 to make 40. So options trading is perfect. It's perfect for those people with a small account. If you only have 2 grand in your account, options trading is perfect for you because you don't have to resort to penny stocks to trade options. If you trade penny stocks, you're trading in companies that you likely don't know. It's not so easy to figure out those companies. It's not so easy to read those charts. Therefore, you're risking a lot when you're trading penny stocks or stocks under $10 because you're not really seeing them in the news. You're not really seeing their numbers clearly. Options trading gives you a way to trade large cap stocks using a small amount of capital. Let's talk about some stock pros and stock cons. Stock pros is that there's no expiration, it's low market risk, and the numbers move slow. So that is actually a good thing for a beginner. So if the stock is only moving up $1 or $2, that means you can lose $1 or $2 if you own only one stock. However, in a $1 or $2 move, when you hold an options contract, that can make $50, $70 difference in the options contract itself. Some stock cons: it's low reward. That means you have to risk a lot to make a lot. So if you have Apple stock and you want to make $5,000, you will likely have to put $20,000 into Apple to swing trade it for that much money. And the numbers also move slow, which is a pro and a con, depending on if you are a beginner or an experienced trader. So as a beginner, you like the fact that numbers move slow. You don't have to worry about risking too much. Therefore, you could only lose like $6 or you can make $6. But if options, then numbers are moving very fast. So like I said, if this does not go in your direction, let's say the stock, instead of moving up this way, it goes up and then it goes down, the value of your option is going to go down with it. And if it doesn't recover up by this expiration point, let's say that this is your expiration point, it doesn't recover and it still goes down, you will likely lose all your $50 on that trade, but you only risked $50 rather than risking $400 here. Remember, this is 400 because this is how much you would have made if you achieved that strike price. Let's say that you risked $400 here and the stock goes down. That means you just risked $400 of your money and you are likely losing a lot more than just $50. So there are some benefits of options trading and stock trading. We at Ayanti obviously prefer options trading because we're trying to help the little guy. We know that not everybody has 25 to 30 or $1 million in their account to day trade and mess around with. Maybe some of us have 1,000, maybe some of us has 10,000. Options trading gives you a great way to avoid trading penny stocks and start trading large cap stocks, which are stocks that you can trust. They usually have a lot of volume, they usually have a lot of catalysts moving them, and a lot of volatility, which is fantastic for an options trader. If you don't know what volatility is the up and down movement of a stock on a daily or weekly basis. A stock that moves up and down like this is very volatile. Therefore, the options contract is going to be a lot more valuable, and we'll get into what that is in the future in these chapters, because volatility is your best friend as an options trader because it gives you the chance for the stock to move in your direction before the expiration date. So let's go ahead and recap a little bit before we end this chapter. We talked about the amount of money that you can make in an options contract versus the risk that you have to put out. We talked about some of the pros and cons of options. We talked about some of the pros and cons of stock trading. And we talked about options versus penny stocks. Again, penny stocks, they're very hard to understand. If you understand penny stocks and you make money, all power to you. Options just give you, no pun intended, an option to trade large cap stocks using a small amount of capital, which is very favored by a lot of the beginners because a lot of people don't have that much money to spare to make an extreme amount of returns. So that brings us to the end of chapter 3. In chapter 4, we're going to be talking about calls and puts, intrinsic and extrinsic value, in the money, at the money, and out of the money options. Now remember guys, if you guys have any questions, please reach out to us on one of our social media outlets, which is on Instagram or Facebook, or you can email us directly at ayantitrading@gmail.com and we'll be more than happy to help. Hey guys, Q here from Ayanti Trading. Welcome to your 4th chapter here with us on options. In this chapter, we're going to be talking about some calls and puts, intrinsic and extrinsic value, in the money, at the money, and out of the money options. So we're going to first go into calls and puts. So it's important to understand that there are only 2 types of options contracts on both the buyer's and the seller's end. There are calls and there are puts. Calls are a bullish position on the future price of the stock. If you have a long call on a stock value, that means you're assuming that the future price of the stock is going to be higher than the price that it is trading at currently. How would you profit from a long call? Say the stock is trading at $10 right now and you are striking at $30. If you are striking for the stock to be above the value of its current position, that means you would need to buy a call option because you are bullish on the stock. So you're hoping for the stock to go up. Your entire goal is to spot the stock that's going to be worth more in the future and buy a call on it until expiration date. So say expiration is at the end of this diagram. If you hold a call, you want the stock to achieve that strike price and surpass it for you to start making money on your option. As you could see, as the stock goes up, that means your option will become more valuable because it is achieving that strike price. So that is what a call option looks like. A call option is a bullish position that you take as a buyer for you to purchase the stock in the future at a lower price than it is actually trading at. So if you were to actually exercise this option and in the future it's trading $40, that means you just netted a $10 gain per stock that you have because of that options contract. However, let's say the stock never achieves that $40. Let's say it only stays at $20 and expiration time has come. That means there's no reason why you would actually go through with this contract. You just simply would not exercise it because you can just go out and buy the stock at market value of $20 rather than exercising at $30 and already starting a loss. Say the expiration date comes and the stock has never achieved this $30 call. The stock had actually moved downwards. That means your options contract is going to be less and less valuable. However, the maximum amount that you can use, the maximum loss that you can achieve would be the $100 that you originally paid for this contract. You never have to lose any more money than the $100. However, the maximum profit is virtually unlimited as long as you sell the contract before the expiration point, and if that strike price is achieved, then your maximum profit is virtually unlimited. As you can see, the profit and losses side, the negative 100, which is that you paid, turned to 200 as soon as that strike price was achieved. and 300 when it surpassed it completely. So as a call buyer, your end goal is for this contract to be worth more as the strike price is achieved. So as soon as that stock hits that strike price, the stock is now considered at the money. That is an important definition that we'll define later on in this chapter. If it's above it, then the call is in the money, therefore your call will be more valuable. On the flip side, there's something called a put option. Puts means that you have a bearish position on the future of the stock. You are not betting for the stock to go up. Instead, you are betting that the stock would go down in the future. That means you enter a contract for a lower strike price in the future than the current trading price. So if the stock is currently trading at $50 and you purchased a contract for $100, again, this is negative because this is the premium that you paid the seller of the contract, and you paid that $100 premium and you set a strike price of $30. That means you're assuming in 3 months, let's say that this is 3 months from now, you're assuming that the stock will reach $30. That means by the time that that expiration point comes, if the stock achieves that strike price of $30, your options contract will go up. So as a put buyer, you want the price of the stock to actually go down because you have a bearish outlook on the future of this stock. So calls and puts are just the exact opposite of one another. A call is a bullish position, which means that you want the price of the stock to actually go up in the future. Your strike price is greater than the current value of the stock. And puts, your strike price is lower than the current value of the stock. So the two examples we just gave were calls and puts as a buyer. Now as a seller, it works a little bit different. So as a seller, you want the exact opposite of what the buyer is hoping to achieve. So as a call seller, you want the stock to move away from the strike price that both parties agreed upon. So let's say both parties agreed upon a strike price of $30 in this case. So you guys agreed that the stock will reach $30 by March 1st, for example. So as an option seller, if you're selling calls, you want the stock to move away from the strike price. So remember, there are two sides to this. There's one buyer and one seller. The buyer of a call option is hoping that the stock closes above the strike price. That way they can actually make money on this call option. The seller does not want to give back his credit. So when you first open a call option as a seller, you'll receive, for example, in this example, a $100 credit. Your hopes is that by the time expiration comes, the stock closes at $29.99 or under and you will collect your full $100. As the stock stays under that $30, you will continue to receive that credit. However, the moment the stock closes above $30, you will start losing that credit, and if it closes above 30 at expiration, you will lose that entire $100 credit. Same thing with put options. With put options, you want the stock to close above the strike price that you guys agreed upon. So you would receive the credit of $100 when you first went into this contract. If the stock closes anywhere under 30, which was the strike price that you guys agreed upon, if the stock closes under 30, that means the buyer of the put pretty much won. He got what he wanted and the stock went under the strike price, and he will receive whatever he receives and you will lose your entire 100. However, what you want to happen is the stock actually closes above 30 and you receive the entire $100 credit. Now, this may all seem confusing, but as we go into the actual charts and the brokerage platform, it'll start making a lot more sense. And as we go through examples, you'll start to see why both sides want certain things to happen, from the call buyer and the call seller and the put buyer and the put seller. But the gist of it is whatever the call buyer wants, the call seller wants the exact opposite to happen. So just because you're selling a call doesn't mean you're taking a bullish position. In fact, you're pretty much being bearish on the stock when you're selling a call on it. So this leads us to our next point in the lesson, which is in the money, at the money, and out the money options. When an option is in the money, it means that the strike price is greater than the actual stock price. The strike price has already achieved its target. So if you strike the stock at $30 and now it's trading at $35, that means the option contract is in the money. Therefore, it will be more valuable. The premium is going to be more valuable on the stock price. At the money means it's exactly trading at the price that you set. So say you strike that 30 and the stock is trading at 30, that means the option contract is exactly at the money. It is equal to the strike price. The stock price and the strike price are equal. Still, the option contract will be very valuable at that price. Out the money means that the option contract, the strike price of it, is less than the stock price. So if the strike price is yet to be achieved, that means this option is in the red. That means it is not as valuable as an option would be as it is achieved the strike price. As option buyers in Ayanti Trading, we want to buy options that are close to being in the money, but not too far out of the money. So you are going to be able to get cheaper option contracts as long as you're not buying in the money. If you buy in the money, yes, the price can go up, but you're paying a lot more for the premium. The whole point of our lessons here is to teach you how to make money risking a small amount of profit. So if the strike price that you're setting is $30 and the stock is currently trading at 20 and you buy the contract, the strike price at 30, that means the stock is still out of the money. That means the option contract is still out of the money. Option contracts that are further away from the money, like I said before, are less valuable. However, they still move up as the strike price gets reached. So as long as the options contract is moving towards the strike price, that means the options contract will become more and more valuable. However, you do not want to buy an options contract that is way out of the money. We'll talk about the differences and which contracts are more favorable to buy based on multiple different things and factors that go into it. But for now, we're just trying to explain what in the money, at the money, and out of the money contracts are. Again, let's recap. In the money means that the strike price is greater than the stock price. So strike price is greater than the stock price. So the stock price in this case would be trading at 40, for example, and the strike price may be 30. At the money means it's exactly trading at the right price. So if you strike that 30 and the stock is at 30, that means the stock option is at the money. Out of the money means that the strike price is yet to be achieved. The stock may be trading at 20 and your strike price may be 30. Alright, so the next part of our course, which is in the same chapter, is going to be talking about option premium. So this is the price of the option that you are buying. And options are made up of two different parts. One is intrinsic value and the other is extrinsic value. And it's important to know both to understand how the option premium price came to be. So option premium price breaks down to intrinsic value, which is the market price minus the strike price at expiration. We'll go into an example which gives you an exact number of how that is made. And then extrinsic value is time and implied volatility. So remember how options have a time decaying factor, so there is an expiration point. That plays a factor into the price of the option. The closer you are to that expiration, the cheaper that option is going to be, as well as implied volatility. Implied volatility means how much is this stock swinging up and down, because the more volatility it has, the more likely it'll swing into the strike price that you had chosen. Therefore, the option's value will be more valuable for you to purchase. So again, intrinsic value breaks down to market price minus strike price. So the actual price of the stock minus the strike price that you set it at. And then extrinsic value is time and implied volatility. And we'll go into some examples to give you an exact understanding. So before we actually explain the intrinsic value of this chart, let's go ahead and break down all the different components that go into an options contract when you're looking at it. and we're going to do so on our stock trading program, Robinhood. Okay, so Robinhood is great for beginners. If you've taken my first course, you know that Robinhood cannot be used alone. It is not the best trading platform, but it is commission free, so it's perfect for beginners. And this is not an advertisement. I'm just an advocate of it for beginners. Again, this is not an advertisement. So let's go ahead and look at some different options on the actual trading platform itself. So here I've pulled up the S&P 500 index, and it's just after hours trading, so the market just closed. And so we want to look at the options for this index. If you are trading on Robinhood, you have to go into settings and enable options. You actually have to agree to something before you can start trading them. On other trading platforms, I believe it's the same thing. So you have to have options trading enabled, and then you'll be able to trade options. But to the right over here, you see a space that says Trade SPY Options. So let's go ahead and click on that and see what happens. So the first thing we see at the top, it says SPY buy call. There's buy and sell, and then there's call and put. Remember, at Ayanti Trading, we're mostly buyers. We're never actually selling options. And like I said, do not be discouraged from selling options. If you want to sell options, then go ahead and do your research on them and try to figure it out for yourself. But we're focused on teaching you on buying options because it's been profitable for us in our strategy. And then there are calls and puts. Remember, we've already explained what calls and puts are. Calls are a bullish stand that you have towards the stock. That means you're assuming that it's going to go up. In this case, it would be the entire market because it's the S&P 500. Or put, on the other hand, means that you are bearish on that position. And then to the right of that, you could see that it says expiring, and then it gives you a list of different expiration dates. And as you can see, you can go way far out till 2021. At Ayanti Trading, we usually don't go more than 3 months in our stock options, and typically we don't actually hold for more than 1 month on the contract itself because we are aware of time decay. We're aware of the fact that as the time gets closer to the expiration date, the option contract is losing money, and we'll tell you exactly how to estimate how much money you'll be losing per day that you hold that contract. So let's go ahead and set out these option contracts till April 10th, okay? And then as you can see, it gives you an entire list of option contracts. The first thing we want to point out is the strike price to the left. The strike price means that this is the price that you're assuming the stock is going to be by April 10th. So as a buyer, you are looking at the strike price because this is what it's going to matter in terms of how much in the money the option is, how far out the money the option is. So if SPY is currently trading at 279.52 and this strike price is at 279, that means that this option would be considered in the money. As you can see, it's a nice little break. Most brokerage accounts will give you a line in which it will define the in the money versus out the money options. This option contract right here is trading out of the money because it is at 280, or this would be considered almost at the money. This is out of the money, and then the further you go up, the further out of the money the strike prices become. So if this strike price is at 287 and you're assuming the stock will go up to 287 by April 10th, then you're very bullish on the stock, but you pay a lot less for the option contract because it's way out of the money, considering there's about a $7 difference or $8 difference between the actual share price and the strike price. And so as you can see, the price of the contract becomes less and less as you move further away from the money. And the option price is also less because it's only expiring April 10th. We're currently on March 25th. So it's not that much time that we have before expiration. So if we move it a little bit further, let's say we go to June 21st, you can clearly see that options become a lot more expensive. They jumped from $1 something a piece to $6.04 a piece. And we'll explain why they're only in dollar amount, not a larger amount in just a moment. The break-even price only matters if you're actually exercising the option. This is just the strike price plus the price of the option combined, which is the break-even price. So it doesn't really concern us too much on the break-even price. We're primarily focused on the strike price. Percent change, this is how much the option changed within the day. And then this is how much the option trade changed within the day in dollar form, so in pennies form. So why is the price, let's go back to April 5th, why is the price in $2.08? Why isn't it 208? It's because the option contract is multiplied by 100. So when you're purchasing this contract, if you actually wanted to buy it, you would pay 208 for it because it's multiplied by 100. You wouldn't pay $2.08. So if we move further in the money, which means that the strike price is already achieved, the share price is above the strike price, options get a lot more expensive, as you could see to the right. Now you're going up to options worth $10.93 or $1,093 and so on and so forth. They can get very pricey. As you can see, this is almost $5,000 for this option that had a strike price of $230. So we'll talk about which ones to buy in the future in later chapters, but for now, we're just trying to break down the different components of an options contract, and we'll even get deeper on those in the future. But just to break it down, we have the strike price, which we've already explained, the percent change in the price, expiration, calls versus puts, and then we have the bid and the ask. If you're familiar with stock trading, you already know what the bid and the ask is. We'll have a chapter on that later on. The previous close, this is what the option closed at previously. This is the highest point it's achieved. The lowest point it's achieved. Volume and open interest, which we'll talk about that momentarily. Implied volatility, we've already spoken about the importance of implied volatility. Again, like I said, we're just briefly going over everything, but we'll explain all this in heavy detail later on. And then the Greeks, which are going to tell you a lot about the options pricing movement. So we'll have an entire chapter dedicated to the Greeks because they're very important to understand. Don't be alarmed, they're very easy. We try to break them down to you very easily at Ayanti Trading, so you'll understand the gist of them pretty quickly. So now that we've broken down the different components of an options pricing table, let's go ahead and jump back into intrinsic value. So just to recap just a little bit, an option premium, which is the total cost of the option as we showed you on the previous video, which is the $2.06, for example, multiplied by 100, is made of two different sections, which is intrinsic value and extrinsic value. Intrinsic value is going to be the market price minus the strike price, which equals intrinsic value. So if the option was to expire today and your strike price is at 278, you would subtract the actual market price of the share, which is 278.77, minus 278, and it gives you 0.77, which will factor into the option's price. That is only if the option was to expire today. So intrinsic value is pretty simple. It's just the market price minus the strike price. If the option is in the money, it's going to be positive. If the option is out of the money, it's going to be zero. You're never going to lose more than you put in. You don't have to worry about losing 300 when you only bought the premium for 100. So again, just to kind of recap just a little bit, an intrinsic value is the market price, so the actual share price minus the strike price. In this case, you would subtract 278.77 from 278. It gives you 77 cents or $77, which will factor into the total option price. So $77 of this full price is coming from intrinsic value alone. The remaining balance is coming from something we call extrinsic value. Extrinsic value is made up of two different things, which is time and implied volatility. Time is how long do you have until expiration date. Remember how we showed you in the video example? The longer we go out in time, the more chance you have for that call to go towards the price that you striked at. So the longer you give yourself, the more valuable options are going to be. And then implied volatility. If you don't know what volatility is, and you haven't taken my day trading course, then let me go ahead and try to show you on a graph. Volatility is the amount that the stock goes up and down per week, per day, whatever it is. And a non-volatile stock goes in one direction. Usually it will have its little lines, but it will very much stay in that little direction. It will not swing up and down like this. The more volatile the stock is, the more valuable the option becomes. And if you put two and two together on that, it's because the more likely it will swing in the strike price that you favored. If you have a strike price of, for example, $30, let's draw $30 right over here, and the stock is currently trading at $20, you bet that the value of the option will be more valuable than it would be on this stock, because now there's more of a chance for the stock to swing in your direction. Therefore, its option, or call option in this case, will be more valuable. The extrinsic value will be more valuable. And as you go out more and more in time, both the time and implied volatility will make the option more expensive. So we're going to go back to the video that we had shown you earlier on Robinhood, just to re-explain this again, just so you can try to get the hang of it. Because this is very important to understand. It is literally, your guideline to knowing which options to buy and which options to stay away from. So now that we've explained intrinsic and extrinsic value, let's go ahead and look at it on the actual chart. So if we're looking at this strike price of 278, the share price is currently trading at 279.47. That means that the option is in the money indeed, and it's separated by this line, as we mentioned earlier. So if the expiration is April 5th, that means the option is going to be more valuable. We're currently on March 25th, so it gives us 10 days, 10 market days for the option to swing in our favor. So it's already in the money. So as an option buyer, you're now hoping that it stays in the money, or it actually keeps going above this level of 279.47. Therefore, the option contract will become more valuable. So let's compare this option contract with this option contract. So this option contract is $278 strike price, which means that it is $1.50 within the money. So this option contract is already valuable. It's valued at $379 total when you buy it. And if you compare it to the one just under it, which is just 50 cents more in the money, this option contract is worth 411. So you can assume that if the share price of this stock jumps up another 50 cents, that would make this option contract almost the price of this one. So you only spent $379. You held until SPY jumped up another 50 cents, and therefore you made all that profit just by spending $379. So you spent $379 to make another $40 or $50 in profit. You do not have to actually buy in the money options though. You can go further out of the money and choose one of these call options. And as you can see, 50 cents makes a huge difference. Here you go from 124 to 142. Now, this is not guaranteed that it will be the exact amount of profit, because remember, there are other factors coming in here, such as time decay and such as implied volatility. But it is safe to say that if the stock jumps up another 50 cents, you're probably going to be making around $30 on that jump if you hold this option contract right here. So remember, the end goal for us is to buy a call options and have the share price move towards the strike price. It doesn't necessarily need to achieve the strike price. As long as it's moving towards it and that expiration date is still a little ways away, the option contract will become more valuable. And we as buyers will never execute. From Ayanti Trading, we don't ever execute the contract. We wait for it to become a little bit more valuable, so we hold it from 124, wait for this the strike price to get a little bit closer, and then sell it for profit before we actually have to execute the option. And then let's go ahead and go further away from the expiration. Let's go ahead and go to May 17th. And just to give you another example, we've already shown you this. As you can see, the price of the option gets significantly more expensive as it is more in the money in these cases. And then the further you go away from the money, again, the cheaper the options become. So there are multiple different factors playing here. It will be intrinsic value, which is the strike price compared to the market price. That is one thing that's contributing to the price of the option. Another thing that's contributing is extrinsic value, which is time and implied volatility. How volatile is this stock? How much does it move up and down? What is the likelihood that it will swing in your direction before the expiration date? So that brings us to the end of chapter 4. Again, let's recap. In chapter 4, we talked about calls versus puts. Calls being a bullish position on the future price of the stock, so the strike price is going to be higher than the current trading price. Puts are the opposite, so you are betting against the stock here. You're betting that the stock will be less valuable in the future, so your strike price is going to be lower. In the money options are options that have already achieved their strike price. So the strike price in this case is less than the actual price of the stock. That's in call position. So if you have a call option, you want the strike price to be less than the actual market value of the stock. It's the opposite in put options. In put options, you want the strike price to be greater than the price of the stock. Remember, so if we're looking at this diagram right over here, if you're striking at 30, you want the price of the option by the time expiration hits to be less than 30 because you are betting against the stock. You don't want it to go up, you want it to go down. With calls, you want the price to go up. At the money options are if you are striking at 30 and the price is trading at 30, that means you're at the money. The option is worth exactly the market value minus the strike price. So they are equal to one another. Out of the money means that the strike price of the call option is greater than the market value price. So remember, these are just the book definitions. We've already explained that to make money on options, you don't need to be in the money. You can buy options out of the money and still profit from them. We'll go more through that in later chapters. Then we talked about option premium. So how do options actually attain this price right over here? How does it come about? What are the different factors that go into it? And we explained that that is intrinsic and extrinsic value, which is intrinsic is market price minus the strike price, and extrinsic would be time and implied volatility. So time till expiration and how volatile the stock is. So thanks for tuning in, guys. We just finished chapter 4. Feel free to review these chapters. I know some of them are kind of hard to understand, but you need to understand these basic things before you're able to jump in and trade options successfully, because there are a lot of different factors that you must understand before actually trading options. So we'll move on to chapter 5 in the next session. Thanks for tuning in. If you are liking what you're watching, please share it with a friend. Not the actual video, but share with a friend what we're doing at Ayanti, and have them take a look at our website, take a look at our courses. That way they can learn for themselves. Hey guys, welcome back. Q again from Ayanti Trading. In chapter 5, we're going to take things up a notch. We're actually going to go more in depth into options. It's a pretty heavy loaded chapter. We're going to be talking about implied volatility, which is massive. This is a huge subject in options. We're going to talk about the bid and the ask. Again, bid and ask, very important for options traders. It's different than the bid and the ask for stocks. Bid and ask under options kind of means the same thing, but we'll talk a little bit more about why it's important to buy at specific points and what points to set at. We're going to be talking about volume and open interest as well. And finally, we're going to be covering the Greeks. The Greeks are what tell you how much money you can make when you're trading options based on the numbers that you see within the explanation of the options contract. So without further ado, let's go ahead and get started. So the first thing we're going to be talking about is implied volatility versus historical volatility. So basic definitions: implied volatility is the forecasted move of a stock in the future. So if we want to look at the Apple stock price and we want to see where it could possibly go in the future, implied volatility tells us that range per se. This is based on options that are at the money. So if we take options that are at the money, remember, at the money means that they're very close, or they are right at the point in which the strike price and the actual stock price are meeting. So if we take options that are at the money and we take the implied volatility from within those options, it will give us the forecasted move of a stock in the future between 2 percentage points. So we'll go ahead and explain that in an example in just a little bit, but that's just the basic definition and where it's derived from. Historical volatility, on the other hand, is the actual move of a stock over a historical period. So implied volatility is a forecasted number. It's not set in stone. The stock may move between those two numbers and may go above, or it may be lower than those two numbers. However, historical volatility is the actual move of a stock over a historical period. So, for example, if we're talking about Apple over the next year, let's say that this is going to be 2020 and we're currently in 2019. So, let's say we're looking at Apple, and currently Apple is trading right at this point. Let's say it's at $194 right now. And we want to know what it could do in the next year. The implied volatility gives us a projection of where the stock can go 68% of the time. We'll talk about where that 68% came from, but this would be the highest point that it can go 68% of the time, and this would be the lowest point that it would go 68% of the time. So that's what pretty much implied volatility tells us. It gives us a projection that this would be the highest point and this would be the lowest point that it goes 68% of the time, and the other 32% the stock may move down here or up here. So let's talk about where we get the 68% now. If we have to determine that number from somewhere. The 68% of the time, or 68.2% of the time really, is the one standard deviation, which measures the total outcomes that can happen within a year. So a standard deviation measures 68.2% of total outcomes that can happen within the 1 year trading period. A stock's implied volatility reading gives you a percentage of expected move annually on one standard deviation. So, for example, if we look at stock XYZ, which is at $50 and it has an implied volatility of 20%, that means the stock can move 20% above or below that $50, which equals $10. So the stock can move down to 40, or it can move up to 60, 68% of the time within the next year. So as the stock fluctuates up and down, it can move up to 60 or down to 40, 68% of the time. That's the implied volatility. That's not set in stone. Anything can happen. However, this is based on historical volatility combined with implied volatility, and people's projections for that stock. The other 32%, which is 16 and 16 on both sides, the stock can very much go below 40 or above 60, but there's only a 16% chance that would happen based on implied volatility. So let's review a little bit before we go any further. So we talked about implied volatility versus historical volatility. Implied volatility is forecasted on the stock's future movements based on options that are at the money. So when you're looking at an option and it's at the money, it will give you a percentage of implied volatility, which tells you where a stock can go up and down. And then historical volatility is the actual move of a stock over a historical period. So that's a known number. We know historical volatility. We forecast implied volatility. But when we compare them, implied volatility is usually overstated. So overstated means that usually or typically markets overstate the amount of movement that can happen within a stock. Determined by the yellow line on the right, as you can see, there was a 60% chance that the stock would move up this much. However, the historical volatility shows that it only moved by 50%. So implied volatility tends to always overstate. How does this affect you as an option trader? We cover that in the later part of this chapter. So don't worry about that too much because we're going to cover that. But let's review a little bit and try to talk about options when we talk about what determines their pricing. So we talked about in the previous chapter an options premium. An options premium is determined through intrinsic and extrinsic value. So if we talk about the extrinsic value, we break it down to time and implied volatility. Obviously, an option's intrinsic value can be calculated by subtracting the strike price from the market price. We have a very set number. However, how do we determine what is the value that an option is getting from its implied volatility? We can't. Unfortunately, we cannot. However, if you learn how to manipulate your option buying and selling strategies to your favor based on implied volatility movements, then you can make a lot of money buying and selling options contracts, knowing when implied volatility is usually high and knowing when it's too low. So let's go ahead and jump back in and review a little bit more about standard deviation just so we can cover it once more. Standard deviation is one standard deviation is measured 68.2% of total outcomes. So remember, when we talk about at the money, when you take the at the money implied volatility of a stock and you look at standard deviation, you can take that stock if it has an implied volatility of 20% and you can forecast the stock to move between these two prices over the next year. However, one thing to keep in mind, implied volatility does not mean the stock is going to go in a specific direction. It can be either up or down. There is, some kind of stigma with implied volatility that's common amongst traders that they think that implied volatility means that a stock is going down. Yes, the markets historically show that they are higher, that they have a higher volatility when things are going down. However, it does not mean that the stock is going to go down if it has a high implied volatility. It just means that it has a bigger range of swing. So let's talk a little bit more about high and low implied volatility. So when we're talking about a highly volatile stock or high implied volatility, let's say there's a 68% chance that the stock in the black line would move to these two levels, and there's a 68% chance that this stock would move to these two levels. Which one do you think you would pay more for when you're buying an options contract? Obviously, the one with the black line. You would pay more for this stock's options because there is a higher chance, there is a higher implied volatility. Therefore, the implied volatility being high causes the options contract price to be higher because it's more likely to swing in the direction that you picked. If you bought this stock in the red line and you wanted to go to 120, you wouldn't be paying much for that options contract because compared to another stock, which can go up to 120 easily as it shows its implied volatility, now you get to have to pay more because there's a higher chance that the stock will swing in the direction that you favored. So some key notes on implied volatility. There is no absolute number that would be considered volatile. Every stock is subjected to its own historical volatility. Yes, when you look at a stock, it may look volatile to you, but that stock is only volatile when it's compared to its own historical volatility. So every stock is different. You have to compare its historical volatility versus its implied volatility for you to know if it's a volatile stock or not. Meaning that if Apple usually through history has a 15% volatility rating, however right now it's at 32%, then you can very much assume that options contracts are going to be higher at this point due to the fact that it has a higher volatility reading than it usually does. When you're when you're trying to figure out if a stock has a high or low volatility reading, you must compare a stock's low and high points to its own current volatility to determine whether it's relatively on the high or the low side. We're going to go into a website in just a moment that can show you usual volatility, 52-week volatility. That way you know how to compare them yourselves. And stocks this is very important. Stocks tend to have a higher volatility reading when they're nearing earnings. The reason why is because stock option buyers and sellers are very active when it's close to earnings. Therefore, the stock has a higher volatility reading. People are expecting the stock to make a massive move. Also to note that when a stock has a massive drop or a massive increase, there's also a higher volatility reading. You have to be careful knowing when you're buying your options because if a stock has temporarily high volatility and you buy a stock option that is 1 month away from expiration, however the stock's volatility is temporarily high because of that reason, then you can very much lose money on your option because the volatility starts to go down. I know it's a little confusing, but we'll jump into an example that shows you exactly what I mean in just a moment. But just know that options tend to have a higher volatility, or a stock has a higher volatility when it's nearing a significant earnings call, some kind of court case, or some kind of large drop due to bad earnings. So anything of that nature can affect its volatility. So now let's go ahead and jump into this website. This website is called, let me write it out for you. It's called iVolatility.com. volatility.com. So this website will give you all the information you need about volatility. Let's go ahead and jump into it. That way I could show you a little bit how to navigate it and where to look to see implied volatility, high volatility versus low volatility, 52-week high versus 52-week low. So let's go ahead and jump into that website right now. All right, so we've navigated to ivolatility.com. This is the landing page that you come across when you look up ivolatility.com. What you want to really look for is under services and tools, you can go to analysis services and go to basic options. So when you're looking at this website, what do all these numbers mean? The really important thing that you want to focus on as an option buyer, if you're on the buying side, also if you're selling, this can also be very helpful. But let's focus on the buying side. The first thing you want to look at is the current implied volatility of Apple. So you have the index calls and the index puts. So at the money, index calls are 26.49% volatility and index puts at 26.14% volatility. The mean between those two is 26.32. So Apple has a 26.32% volatility reading at the moment. When you're comparing that to its 52-week high or 52-week low, then it can determine if this is actually a volatile move or a non-volatile move for the stock. If its 52-week high is reading at about 45% and 52-week low is reading at about 16%, then that tells you that this currently is a small volatile stock. It's not too volatile, but it's also not too non-volatile. Therefore, it may be a safe bet for you, an option buyer, for the long term. Now, if you're trading options within the same day, volatility may not play such a big part in your trade. However, if you're planning on holding options for a month, then you don't want an overly volatile stock compared to its past. Meaning that if Apple was currently sitting at a 40% volatility and its highest in the past 52 weeks was 45%, because like we said, implied volatility is usually overstated. It's overstated means that traders usually over exaggerate how much the stock is actually going to move. So if it's sitting at 40% volatility instead of 26%, that means that the option premium is overpriced. Remember, option premium is made up of intrinsic and extrinsic value. Extrinsic includes time and implied volatility. If the implied volatility is at 40%, it's contributing to a higher option premium price. Therefore, as time goes on and the stock does not actually fulfill that implied volatility up to 40%, the option premium price will naturally just get lower and lower. Therefore, you will lose money on your options contract. You may not lose all your money if the stock is moving into the direction that you expected it to or you called for. However, implied volatility will start chipping away at your profits because it's starting to go down over the weeks that you're holding the option contract. So that's pretty much the gist of it. That's pretty much why I go to this website. I go just to compare the current volatility versus the 52-week high and 52-week low for the stock. It really gives you an idea of just how volatile the stock is when compared against itself. Like we said in the keynotes earlier in the chapter, we talked about implied volatility being subjective to the stock itself. So just because Apple is volatile doesn't mean that it's volatile against other stocks. It's just volatile against its own history. All right, so back to the PowerPoint. We talked about a stock's volatility compared to its low and high points within the 52-week period and how to determine that using the website ivolatility.com. Keep in mind, I'm not advertising for any websites, guys. These are just websites that I use for myself and I've found accustomed to. You're free to go ahead and research your own website, see if there are different things that can help you determine volatility. There are indicators that you can put on your actual trading tools that can tell you volatility. I just wanted to show you the easiest way that I navigate it. However, it's completely up to you to do your own research and find your own things of doing things. Please don't think that anything I'm doing is set in stone. Trading is very subjective, so a lot of different traders may disagree, may agree with me based on what I do and how I determine things. So let's talk about how it impacts you. How does volatility impact you as an option buyer? We talked about that briefly when we were on the website, but I want to discuss it some more. So history proves that implied volatility is often quoted higher than the actual market. Therefore, options will be naturally overpriced. So if options are naturally overpriced for you as a buyer, you can automatically assume that if you hold those options, implied volatility is also working against you with time. So if you looked at that website and a stock is too volatile or its implied volatility is higher than usual, then if you buy that option contract and you hold for 2 month period, 3 4 week or 2 month period, then you can very much assume that if implied volatility starts to go down, then you will be losing money on that options contract. You may not lose all your money, but it will significantly be lower as the stock implied volatility starts to go down. So pricing of a stock is very important. However, the volatility of that price is very important as well. So we talked a little bit earlier about the different aspects or the different things that can impact the volatility of a stock. Major news events, overall market behavior. You're going to be looking at, anytime that there are earnings coming up, that's also going to cause implied volatility or a higher implied volatility. Any significant news coming out about the company. All those different aspects you have to pay attention to because they can increase volatility dramatically. Also, I've already just talked about this. When buying an options contract, keep in mind that a high implied volatility can likely hurt you in the long term. So, high implied volatility on a stock that's usually not high in implied volatility can definitely hurt your profits. So some more key notes. This is just review. Implied volatility is the expected move in the price for a stock. So it's the range that it gives you. Remember we talked about, I drew out that poorly drawn example for Apple and the range that it can possibly move in to 68% within the next year. Implied volatility does not account for the direction in which the stock is going to move. Also very important to note, it does not tell you if it's going to go up or down. It just gives you a range of up and down. And high implied volatility causes option premiums to be more expensive. So that was pretty much the gist of implied volatility. We're going to be moving on to bid and ask next. So I will break this video now. It's still chapter 5, but I will put an end to this video now. That way you can always refer back to it as the implied volatility chapter. And then we'll move into bid and ask in the next video. So thank you for watching. I'll see you guys in the bid and ask section of chapter 5. Guys, Q again. I hope you are soaking in all the information from our previous implied volatility chapter. I know it can be a little hectic and overwhelming. However, I hope we broke it down for you as much as possible. Remember, guys, if you guys have any questions, you have access to our group chat, and you also have access to DMing us on Instagram at any time. We're very responsive. We try to be very informative on there. We're not going to leave you, hanging when you have purchased the course, and you're entitled to asking questions. So please don't be afraid to reach out and ask questions. We are more than happy to help you because we are here to help you succeed more than anything. We don't want to, leave you in the dark or leave anything vague for you. So please reach out. Ayanti Trading is our Instagram and ayantitrading.com is our website, as you know. And then the group chat, if you have not gotten access yet, please go ahead and reach out to us. We'll put you in there as soon as possible. That way you can start asking the questions to a group rather than just to Q or myself, So without further ado, let's go ahead and start with bid and ask, and then we're going to move on to volume and open interest. So if you know anything about stock trading, then you know what the bid and the ask are. Let's go ahead and review. The bid is the maximum price a buyer is willing to pay for the stock, and the ask is the minimum price a seller is willing to receive. It works exactly the same in options contract. The bid is the maximum premium price that a buyer is willing to pay, and the ask is the minimum premium price the seller is willing to receive. And so it's laid out on the example on the right side of the screen. There's the bid and the ask. Now, right off the bat, I can tell you that this is a terrible option to go into, and I'll tell you why in just a second. If you know what stock trading is or what day trading is, then you know what I'm talking about. But if you don't, then I suggest you take my day trading course, which will explain the importance of the bid and the ask. But generally, you want to buy closer to the bid price. So when you are looking at a bid and the ask, what is it that you're looking for? You're looking for the closeness or the agreement between the two parties. let's jump away from stocks for a second. Let's just talk about a car. And there is a person who owns, an old school Corvette, but it's not really something that's extravagant. But he wants, he is asking for $50,000, but in reality, it's not worth $50,000 to other people. So you have other people bidding 10,000, 12,000, 13,000 on that car, but nothing close to $50,000. That range in between the bid and the ask there, between what the buyer is wanting versus what the versus that range between what the buyer is buying for or willing to buy for versus what the seller is willing to sell for is called the spread. The spread is very important to an options trader because it gives you something called liquidity. So the Corvette is never going to sell at $50,000 because 95% of the market cannot even fathom paying that much for that Corvette. It's just not worth that much. It may be, if it was in a better condition or restored or it had a more value to it, then yes, people would be willing to pay that much. But people are not in agreement. Obviously, the bid, the buyer and the sellers are not in agreement to how much the Corvette is actually worth. So taking this back into this, stock world, I guess, or stock market, when you are seeing a bid that's 265 as shown on this example, and the ask is $3.40. So there are 54 people asking, they are willing to pay 265, and then there's $3.40. There's 53 people asking for that price. Then you can see that there is not an agreement between both parties to how much this option is actually worth. Both parties are, bidding way too low and asking way too high. Based on the stock's price, maybe asking $3.40 is way too high, or based on the popularity of this stock. So remember, the more popular that a stock is, the more likely it will have a tighter spread because more people are looking at this and trading it, which will go into volume and open interest in just a second. But very important, the first thing you want to look at when you pull up an options contract, after you determine that this is the strike price that you want to go in, you want to look at the bid and the ask. You want to see that there's an agreement between both parties to determine if the options contract is going to be easy to sell in the future. So let's say you want to buy this options contract and they're asking for $3.40. Let's say you bought it for $3.30. Somebody cut you some slack. You put in $3.30 in your trading account, and somebody sold it to you for that amount. You're already probably losing on this trade because you are now bidding against whoever's asking for $2.65. You bought it for $3.30 knowing that people are only willing to pay $2.65. There is no liquidity there. Liquidity is how easy and literally, liquid moves through things very seamlessly. And that's what you want when you're trading stocks or options. You want to be able to get out of the contract just as fast as you went into it. And if people are bidding way too low compared to the ask price, then you already can foresee losing on this option because you are not in a tight spread. You want to look for agreement between those two parties. You want the bid and the ask to be close in range. That way it's easy in, easy out, and the stock moves accordingly with the option. The larger the bid and the ask between the two parties, the more volatile that option is going to become. Do not mistake this for implied volatility in the stock. When I say volatile, I mean the more fluctuation you'll see. So say you went in at $3.30 with just a small move from the stock, the option may not move. The option, if the stock jumps up $5, the option may still not move, even though it's moving in the direction that you said it would. The reason why is because there was already a huge difference between the bid and the ask. There is already that room for the stock to move up and down without the option premium actually going up and down. Therefore, you're stuck in an option contract in which doesn't really move accordingly with the stock price. The tighter the spread, the more accordingly the option will move. And we'll show you how that looks on an actual graph on the very next page. So when we're talking about stock price versus tight spread and large spread in options contracts, we want to keep in mind, how does the stock option react to the stock price movement? When you are talking about a tight spread, as you can see, as I've drawn out on this graph, the price of the option tends to be, very coincidentally or parallel. It doesn't, this is not necessarily parallel, but it almost matches the stock's price. So when we're talking about the stock going up to 110, the option contract moves in the same direction. It's smooth, it's going up and down smoothly. But when you are talking about an options contract that has a large spread, because those two sides do not have agreement, remember there is an agreement in how much the option costs between the bid and the ask when we have a tight spread. But when we're talking about a large spread, because they do not have an agreement, if we purchased at 50 and other people wanted to sell it at at 90, then every stock movement may not actually affect, because there's already a disagreement, and then suddenly you'll see a large fluctuation, and then the stock option goes down again, and then another fluctuation, and that's because there's not a lot of liquidity. So every once in a while you're seeing a fluctuation in the option contract because people just can't seem to agree on how much the price actually is, and it's going to be very hard for you to exit that options contract as long as it has a large spread. Now spreads can get tighter over time as the stock moves in the direction that you expect it to, but a large spread is usually a big no-no. You don't want to get into it right off the bat, and that's because it can very much hurt you as an option trader because you're already usually paying more than what other people are willing to pay in the future. So again, when you're looking at a stock option, you want to determine if the bid and ask have a tight spread, because tight spread means easy liquidity. Usually stocks that are not popular have a larger spread because there's not a lot of volume. We'll talk about volume in just a little bit. So before we jump into volume and open interest, let's go ahead and jump into an example of different options under SPY, which is the S&P 500, and a smaller stock, and compare the bid and the ask between the two. So here we've pulled up S&P 500 call options expiring March 27th, and we're only here to compare the bid and ask versus other stocks. So the S&P 500, many people, investors, analysts, they are always putting calls and puts on this market because they want to leverage their other investments. So with that being said, when you look at the spread, there's always a tight spread on the call options on this specific S&P 500 index because there are a lot of people demanding the price, and the other people on the other side are also demanding the same similar price. So there's people trying to buy at 115 and people trying to sell at 122. So there is an agreement of the value of this option in between those two parties. This is getting a lot of attention. This is a very popular index to buy calls and puts on. Therefore, the spread is usually small or tight in between the bid and the ask. But if we compare that to Hexo, for example, when you're looking at a call option of $2.50, there's a bid and ask. Although this is in the money, the strike price is in the money, the bid and the ask difference is 60 cents because this one is not getting enough volume. Therefore, many people are asking for outrageous numbers on their returns. Therefore, they want to sell at 4 and 10 because they had probably bought at 3.50, but they just can't get the liquidity to sell on the other side. So liquidity plays a huge factor into bid and ask because there's not a lot of people buying and selling in this specific option. Therefore, the bid and the ask is just not agreed upon between both parties. So you're going to have a larger spread. Getting into this specific option contract is like a death trap because you are likely not to get out of it either by breaking even or you will lose on your investment before expiration date. So in the next section, we're going to be talking about volume. Volume is, if you know me and you know what I've taught in my day trading course, you know that volume is my favorite indicator because No matter what indicator you use, volume is going to determine whether the actual move is going to happen or not. Because, if you're looking at moving averages and a stock is bouncing over the 20 moving average, then you know to look for volume on that bounce, because if there's not enough volume, the stock will very much dip below it again. If you don't know what I'm talking about, I suggest you take the day trading course. It's located on our website. It can teach you all about volume and how to use it correctly when trading stocks. Now, when you're trading options, volume is almost like a cheat code because you have the upper hand knowing how options work. So you're already a step ahead of the gang, when you are trading options and paying attention to the volume on calls and puts. Volume is the amount of contracts traded the day of. So if a buyer buys 10 contracts of a stock and a writer sells 10, these, cancel each other out, then the volume for that given period is 10. So not 20, and that's because we bought and sold 10 contracts. Not us personally, but anybody out there, when there is 10 buys and 10 sells, the volume for that given period is 10. Volume also offers liquidity. So just like bid and ask, volume offers liquidity, and they go hand in hand with one another, because the higher the volume, the more likely the bid and the ask are going to be closer to one another, because there are more people in agreement with the price. You can use volume as an indicator to show activity. So if a stock call option has more volume than it did last week, then you know the market sentiment about the price of the stock. So remember, from the day trading course, we talked about the psychology of the market. The market has a specific psychology, and for you to succeed, you need to understand its psychology. All the numbers that you're given on every stat, on every single thing, is determined by people's actions and reactions. And the market is very important to react properly to specific actions. So if the volume is increasing on call options all around from what it was last week, if you're comparing the two, then you very much know that other traders are now looking at a higher high on a stock. They're looking for the stock to make an upward move or a bullish move. If option puts are starting to go down in volume, then that is even more reinforcing to the fact that maybe a call option would be a better buy at the moment. So volume offers liquidity because it goes hand in hand with bid and ask, and it also gives you almost a cheat code. If you are familiar with options, which I hope you are getting more familiar now, it almost gives you an insight on what is the market sentiment at the moment. So it's not just looking at the stock's volume, but now you're looking at the option traders' volume, which they set for a week, 2 week, 3 week. That's another thing that you want to keep in mind when you're looking at volume. Are you looking at the call that's going to expire next week, or the call that's going to expire a month from now? Because the call that's going to expire a month from now can very much have a higher volume, indicating that this is what the sentiment of the market is looking at a month from now. Another thing to keep in mind, or actually to just reinforce, that if there is an increase in stock price but not an increase in call option volume, this may indicate a reversal is coming. So to piggyback off what we said earlier, volume can indicate market sentiment about a price of a stock. If stock Apple jumps from 184 to 195, however, call option volume is not moving, it's still low, relatively low to what it's compared to usually, then you know that there may be a reversal coming. It's usually very helpful to look at the overall market call and put options. So look at SPY, as we showed you in the example earlier. If you look at SPY or S&P 500, if you look at the volume and the market is starting to top, it's looking like it's hitting a resistance point, then you know very much that now, if the call option volume is not increasing as it's topping, then maybe a reversal is starting to come, and you want to look at put options, no pun intended. So again, let's go ahead and jump into a graph just to kind of show you how you can play with volume a little bit and to reinforce what I just said. So in the PowerPoint, we talked about option volume, giving you a key to determine whether the market is about to reverse or not. Now, remember, this is not set in stone. This is just my own way of looking at things, and it's historically proven, over time. Nothing is set in stone in the market. Anything can happen at any different point. Remember, while I'm recording this, we're in 2019 under President Trump, which means every tweet, every China headline, every trade war headline is really shifting the market up and down. So the recent volatility in the market is due to all that. And now that we're looking at the market, we have now hit a high, a relatively small high compared to its previous high. But if we put on the RSI, which is the relative strength index. If you don't know what that is, I covered it in my previous course, which is the day trading course. We are starting to go to 70. And so in the next, 2 to 3 weeks, we can very much make another higher high. It looks like the market is consolidating. We can very much go up, but we don't know that for sure. What is the market sentiment? What are people thinking now that we have all these terrible news headlines about tariffs? Not terrible in not in my sense, terrible for the market because it can very much hurt earnings for companies and overall performance and economic outcome. So what is the people's sentiment? What are people or traders doing right now about the market? Are they favoring it in going up or are they favoring going down? Obviously, you don't have volume for the future. However, this is where options come in. Remember, we talked about options in the just previous slide. We talked about them being almost like a key insight to telling you what is the people's sentiment about the future of the market. So if we want to know what people think will happen by June 28th, but we don't know based on our own studies, we still haven't determined really. Let's compare calls and puts volumes around the expected price in the future. So if we just go right under or right at the money for options and we pull up volume, as you can see on a call volume expiring on a call option expiring June 28th, there is 1,835 people in the volume of an option. There's 13,531 open interest, which we'll talk about in just a moment, but actually we'll be covering it a little bit here as I'm giving you these examples. When you compare that to puts for the same at the money option, you're obviously paying more, and the volume has increased to 7,847. So more volume got exchanged from calls and puts. So that can determine what is the overall sentiment in the market. Knowing on Friday everything that happened on Friday. Today is Saturday. So everything that happened on Friday, the outcome at the end of the day, there was 1,835 of these at the money contracts exchanged. And then in puts, there was 7,847. So obviously, people are having a bearish sentiment about the market. Now, this is not, the nail in the coffin. This doesn't mean that the market is going to plunge. But accordingly to accordingly to the sentiment of that people have, it can very much go in a bearish manner because that's what people are expecting more or less out of the market. So it gives you a key insight to the sentiment of the market. Is there a possible reversal coming? Is this a top? Are we going to go down a little bit more for the next month until the end of June and then go back up? All of this can help you. It's not just about looking at one factor. You have to look at all the factors that we've given you. And remember, guys, when I'm covering this in both short-term and long-term options trading. You have to determine which ones to use when. If you are looking at a 1-month option contract, you should very much check the volume of that contract. You need to see, are there a lot of people actually going into put contracts right now, or are there more people going into call options right now? So you have to look at that when you're looking at a month out versus when you're day trading. Now, if you're buying and selling the same day, really you're not looking at all those different factors. You're really looking at more the Greeks, the bid and the ask, and implied volatility and such. But for long term, anything you want to hold over, I would suggest 2 weeks. I would really look at volume to determine how many other people are actually looking at this. Volume is important when you're day trading options. You want to make sure there's enough volume because you want to make sure there's liquidity. But when you're talking about having that insight to where the market is going in the future. Volume determines possible reversals or possible moves in the future. So we talked about volume and we covered just a little bit about open interest. So let's go ahead and take it further into open interest. Right off the bat, on a superficial level, open interest and volume offer you liquidity. So the higher open interest and the higher volume, the easier it is to get in and out of that option contract. That's one thing that is superficially known to most option traders, but we want to take it a step further than that. We want to look more in depth to how volume and open interest can give you sentiment about the market. They tell you what other traders are thinking. So let's explain what open interest is. Open interest is the amount of contracts that are still open between the buyer and the writer. So if the buyer, buys a contract and the writer opens it, that means there is one contract that's added now to the open interest. It's important to watch because it can help you see which trend the stock is going for. So if a stock is going up and open interest is increasing, that means that, if the call option open interest is increasing and the stock is also going up, that reinforces the idea that the stock is going to continue to go up. However, if a stock is going up and open interest is starting to decrease, that is an indication that short sellers are starting to cover their positions and money is starting to leave the marketplace. Therefore, the stock may very well have a reversal. So when you're looking at an options contract and you're looking at both the volume and the open interest, you want to keep in mind that volume is updated intraday. So you're seeing the amount of contracts that are exchanging hand on a daily basis, whether it's buying or selling. Open interest is updated at the end of the day. You'll only see yesterday's open interest till it updates after market close. And so another thing to keep in mind is volume and open interest can work together for your favor. So say an example where volume increases above the open interest of the stock. So there is more exchanging. There are more people buying and selling the option contract. The same option contracts are existent. They're still buying and selling them interactively through the day, and volume starts to exceed open interest. That can tell you and suggests that option was high for that day. That means that a lot of people are starting to look into that option. Therefore, there's a lot more volume within that option contract. However, if volume is starting to increase and open interest is starting to decrease dramatically, that can tell you that a lot of people are starting to cover their positions. This is when it's call options. A lot of people are starting to cover their positions and exit that option contract, which can be actually detrimental to the price of the stock, because if you are an aware option contract buyer and seller, which you will be after this course, then you will be aware that as open interest is decreasing and the stock is increasing, that's not a favorable trend, because the stock actually is slowing down in terms of options and the sentiment about its future. Therefore, it's likely going to reverse. Now, this is not set in stone. Anything can happen on the market, but using volume and open interest hand in hand can really tell you what people are feeling about the future of the stock. Keep in mind that you want to look for the expiration dates, proper expiration dates. You want to compare them. You don't want to compare an option contract that's expiring in a week to another option contract that's expiring in a month. So if you're comparing calls and puts, you want to have them at the same length. That way you're not comparing things that don't necessarily go in the same bucket. So again, open interest is the amount of contracts that are still open between the buyer and the writer, and it's not updated during the day. It's updated after market close. You'll see the open interest. You'll only be able to see yesterday's. Volume and open interest can be used hand in hand to give you the sentiment of the overall stock and the future of the stock. If the price of the stock is going up and open interest on call options is starting to decrease, that means it's actually pushing against the trend and things are likely to reverse soon. So there you go. Now you have an edge as an option buyer. You can take volume and open interest and have a key insider knowing when the markets are starting to top. So if SPY is starting to hit a resistance level and you're interested in seeing how other people are feeling about it, you may want to look at the call and put options, compare their volume and open interest, take notes on a day-to-day basis for a couple of days, and see what numbers are playing when. That way you can determine how other people are feeling. So in the past chapter, we covered volatility and the importance of it when you're trading options. We also talked about the bid and ask, volume, and open interest. And so now that we've covered most of the basics and options, the question becomes, how do I determine how much money am I going to make and how much money am I going to lose in time when I'm buying or selling an options contract? So under stats of an options contract, you're going to see something called the Greeks. Now, most people freak out because they're, questioning what is delta, gamma, theta, vega, and rho. What is that? That sounds so confusing. It's out of my, capacity. However, it's very simple. I'll break them down for you as simple as possible, and I guarantee you by the time you walk away from chapter 5, you'll know how to read the Greeks so easily because they're actually fairly simple to understand. So the first option, Greek, that we're going to go over is delta. Delta is the dollar amount that you could potentially make on every full dollar that the stock increases. So for example, let's say you paid $400 for a stock call option. So this is a call option, okay? And let me write this out for you. Sorry, it doesn't look that good. So you paid $400 for a call option on a stock, and you want to know how much you can potentially make if the stock moves up, towards the direction in which you placed. So if the stock moves up by just $1, the way to determine how much money you would make is you multiply delta by 100. So you take whatever delta is and you multiply that by 100, and there you get $78. So for every dollar move, remember, for every whole dollar move, all other things being equal, if for every whole dollar move, you can make an additional $78 on the option that you had purchased. So that goes both ways. Now, if the stock goes down by $1, now you're going to be short $78. So it doesn't always tell you what you're going to make, but it also gives you a risk. So if you bought, stock in Caterpillar, and if the stock goes up by $1, congratulations, you made $78. You can sell, you can do whatever you want. If the stock goes down by $1, you're gonna lose $78. Perhaps more, perhaps less. Same thing on the other side. You may gain 78, you may gain a little bit more or a little bit less. Remember, one thing to keep in mind about the Greeks is that they're always changing. I mean, they're gonna stay around the same, decimal points. However, as the stock goes up and down every day, the Greeks will continue to change intermittently. So they're not set numbers, but they can give you an idea of how much you could possibly make when you are buying a contract, an options contract, whether it's a call or a put. So even on a put contract, for example, let's say you bought a put contract and you paid $200 for it. And right now delta is reading at 78 or 0.78. You multiply that by 100, you get $78. So roughly $78 per dollar move. If the stock goes down by $1, then you profit $78 automatically. If the stock goes up by $1, now you are negative $78. Therefore, this will be worth, $222. I'm sorry, $122 versus the 278 if the stock had moved down. So this goes back to calls and puts. Remember, calls is that you're assuming that the stock is going to go up, you're bullish about the future, and puts, you're assuming that the stock is going to go down, you're bearish about the future. So, and the gist of it, that's pretty much what delta is. Delta is the dollar amount that you could potentially make for every full dollar move. So remember, the stock is not going to jump up $1. It's probably going to go from, like, let's say 105 to 105.50 and then 105.70 and so on and so forth. So as the stock moves in that direction, every little bit that it moves up, all other things being equal, I'm talking about gamma, theta, vega, and everything else staying the same, implied volatility staying the same. If the stock is moving up, that means you're gaining that delta. You're starting to gain that delta little by little. After a $1 move, you'll gain the full delta, perhaps a little bit less, perhaps a little bit more, depending on other things that have changed in the market. So that's pretty much the gist of delta. Delta is not too difficult. Neither are the other ones. You'll see that we break it down for you in such a simple way that you won't be confused at all when you're looking at them. You just have to remember which is which. So delta is, in this case, 0.78. So let's move on to gamma. Gamma is the dollar amount that you could potentially make on every second full dollar move that the company's stock increases. So in this case, gamma is 0.02. So say you bought that Caterpillar stock and it's moved up from 100 to 102. So now what have you made? If it's moved up $2 whole, and by the way, these are very high deltas and gammas. This was probably taken off of a very inexpensive stock. So when delta and gamma are this high, it's usually an inexpensive stock, because usually on like a large cap stock like Apple or Netflix, this would be around anywhere, depending on how far out it is between out of the money or in the money. Usually this number is a lot smaller, but when a stock is about $15, then the delta and gamma will be a lot higher, due to the fact that for a stock to go from $15 to $16, it's a lot harder from a stock that's 180 to go to 181. Therefore, delta and gamma on the smaller cap stocks, or the caps who have a smaller price for their stock, will have a higher delta and gamma. So if a stock goes from 100 to 102, now you've gained delta because it's moved up $1, but it's moved up $2. So now you've gained delta times 2 plus gamma, which in this case, if you multiply this by 100, is $2. So now you've gained $78 times 2, which is 100 and what is that? 56 plus 2, $158. That's how much you've gained because the stock had moved up $2 on your options contract. So gamma is the dollar amount that you can potentially make on every second dollar. Gamma will always be less than delta, obviously, because you're not going to get that full dollar capacity that you're getting with delta. So again, that goes for calls and puts. So if the stock goes down, so if it's at 102 and it goes down to 100, then you are looking at losing $158 if you bought when the stock at 102. So you need to calculate both the potential and the risk. That's what makes a good trader. Don't just look at the upside because that's your bias. You obviously want it to go in your direction, but you want to look at the downside. So if the dollar does go down, or if the stock does go down, you're going to be losing a lot of money very quickly. It's very hard to recover from this much loss unless you're trading in a volatile stock, which it can swing back in your direction before expiration. So again, gamma is the dollar amount that you could potentially make on every second full dollar move that the company stock increases or decreases. I'm sorry, I should have put or decreases depending on calls or puts, depending on which one you're playing. So let's go ahead and clear that up and move on. Theta is time. So theta is, remember how we said that as an options trader, there's always one thing working against you if you're a buyer. So if you're an option buyer, every day that you move closer to that contract expiration, the more you're losing money through theta. So that's the extrinsic value that is comprised of time and implied volatility. Every day that you move closer to theta, the more money you will lose, and theta will increase as you get closer to that date. So in this case, on this specific option contract, theta is going to be negative 0.04. Theta will always be negative no matter what. It will always be negative whether you're buying calls or puts. The reason why is because it's a depreciating factor of an options contract pricing. So in this case, theta is pretty low. It's only $4 because we multiplied it by 100. Remember, this is all approximate. There is a deeper math that gets done here. However, if you want to kind of get the gist and the idea of how much you'll be losing or making through delta and gamma, then you will be multiplying these by 100, so that way you can get a quick answer to what it is. So theta is in this case $4. So if you are losing $4 through theta, for every day that you hold that options contract, let's say you bought it at 100, and let's forget about delta and gamma. Let's forget that the stock is even moving up and down. Let's say you hold it through the next day. And the next day, it's still, the stock is right where it's at. Now you'll have $96 because every day that you hold that contract, theta is working against you. So you subtract 4, and now you have $4 less because theta is working against you. So, a lot of people will ask, if your options are so profitable, why don't you just buy, a very extended options contract? So you buy it a year from now, expiration a year from now, and you can just hold in a bullish market. You can do that, but remember, theta will, every day, let's say, you have an expiration of December, and you're currently in December as well, so you're expecting to have this option expire December of next year. Then if you have a 1-year mark, theta will start off small. However, as you get closer to September, October, November, theta will start increasing. Therefore, you'll lose more and more money as you hold that options contract. Sometimes not enough for it to be profitable or make sense to hold through the expiration or hold until a profitable mark. So let's review theta just a little bit. Theta for both calls and puts. Theta is the dollar amount that the option value will decrease for every trading day. Every day that you get closer to that expiration, theta will start going up. So if the stock is going to expire 2 weeks from now, this theta can pretty much be 0.08 just a couple days from now. So theta, very important to look at when you're trading options. So the next part of the Greeks would be vega. Vega is directly related to volatility. So it's not implied volatility, but it can tell you what could happen if volatility was to change. So if the change in the price of an option can change with volatility, how do you determine what that is? If vega is 0.20 in this case, and volatility currently is at 17.34%, if this volatility goes up by 1%, 1 whole percent, then your option contract, as a buyer, not a seller, as a buyer, your contract will go up by $20 because now you have a higher implied volatility. Remember, we talked about volatility thoroughly in the beginning of this chapter, how volatility is directly related to the price of an options contract. Well, there you go. Vega is directly related to volatility. And so if the stock implied volatility goes up by 1 whole percent, your option contract will increase by $20 roughly, if all other things are being equal. Let's say delta, gamma, theta, and rho did not change, the price of the stock did not change, however its volatility increased, then you will have another $20 added to your original asking price. So if you bought the stock at 400 and its volatility, if you bought the option at 400 and the stock's volatility goes up, then your vega will also increase with it. Therefore, your option contract will be worth 420. Remember when Elon Musk said that he would take Tesla, private at 420? That was pretty funny. If you know what I'm referring to, then you would actually laugh. It was after his Joe Rogan interview, so that was pretty funny. I don't know if you remember, but that actually had a dramatic effect on the market. So anyways, back to, focusing. Vega is directly related to volatility. It's very easy, V and V, so you really can't mess this one up. The way I determine delta is D and D, so for every dollar move, you're getting that. Gamma, you just have to remember it. Theta is T and T, so theta has to do with time, T and T, and it's always negative, as we said. And then finally, rho. Rho is tied directly to interest rates. We're not going to really explain rho because it just matters for, contracts that are held for 6+ months. Interest rates can, really have a cause or an impact on the market completely. But when you're trading options, really the first 4 is really where you want to focus, because these are going to be your bread and butter. Where at Ayanti, we don't really holding options over 30 days. So rho is not really that important to you. So let's go ahead and review the Greeks a little bit. Delta is the dollar amount that you can potentially make on every full dollar that a company's stock increases. So delta in this case is 0.78. We determined that by multiplying 100 times 0.78. Like I said, there's a deeper math than that, but just to give you an idea of how much you can potentially make, it's $78. Gamma is for every second dollar move, so the gamma does not kick in until the second dollar. So I forgot to mention this earlier, but if a stock goes up from 100 to 103, now the stock has moved up by $3. So how do you calculate how much you're going to make? So I forgot to mention this earlier, just so I can mention it to you now. Let's say the stock has moved up from 100 and now it's sitting at 103. The stock has moved up three whole dollars. What does that mean for you? How much money are you making? What you're going to do is you're going to take delta, multiply it by 100, gives you 78. So you take $78 and you multiply that times 3 because the stock moved up 3 whole dollars. And you're going to add theta. So you're going to add gamma. So gamma is in this case $2. So you don't multiply it by 3, you multiply it by 2. The reason why is because you didn't make gamma on your first dollar jump. You only made delta on your first dollar, and gamma kicked in after the second dollar. So you're going to multiply, $2 in this case times 2. And then you're going to determine how much money you can possibly make or lose per those dollars that moved up and down. In this case, I'm not going to do the math, but you kind of get the gist. So remember, the first dollar, gamma doesn't count, but for every dollar after that, it starts to count along with delta. Let's continue the review. Theta, as we talked about, theta starts with a T. It's time. It's the dollar amount that the option value decreases on every trading day. Theta will never be positive. It's always negative, so it's always working against you. Very important to see theta. Very important to look at theta when you're trading an option, a month away or 2 months away, because it can eat away at your profits so quickly. Vega is directly tied into volatility. It's the change in price of an option per 1% increase or decrease in the underlying volatility. And then finally, Rho, we just covered that real quick. It's, only matters when you're trading options for 6+ months as interest rates are tied into the market. So some mistakes to avoid that I have just written out real quick. Holding high theta options overnight. So we'll show you some examples of what high theta options look like, because they can really eat away at all your profits that you're hoping for. Purchasing calls and puts that were really cheap to save money. You will see why I put this in here, because as you go away from being at the money, the further you are out of the money, the cheaper the calls and puts will be. But you will see that those calls and puts will have a whole different Greeks to them compared to ones that are closer to being in the money. Purchasing an option with a large bid and ask spread. So that's a huge no-no. You do not want to be in options that have large spreads, because they usually don't have easy liquidity and there's not an agreement on price. Most of the time you end up losing money on those options. And finally, purchasing options that are too close to expiration. You want to give yourself some room to breathe in case things don't go in your favor, and you want to hold the option for a longer period. Don't buy options that are expiring tomorrow if you're hoping for an entire move on the stock, obviously, because then you're putting yourself at risk. There's nobody, forcing you to buy anything. You can purchase options that are a month away and still profit and sell the next day. It's better than purchasing options that are expiring, in 2 days, hoping that it would swing in your direction the very next day. So anyways, let's go ahead and move into an actual example on the actual brokerage platform. That way you can see how options Greeks are laid out, which ones are better than others, and so on and so on. Alright guys, so now we're jumping into an example of how options are presented to you on your actual trading platform or your brokerage. Now, I use Robinhood to look at my options contracts, but I don't execute through Robinhood. You can also do that yourself. I like the way Robinhood presents the options contract. They're very easy to read and straightforward. You don't have to navigate through different sections. Everything is laid out right in front of you. So what I do is I look at Robinhood, check out the different options that are available for the stock, and I go execute them on my Thinkorswim platform. Thinkorswim is personally one of my favorites. I've covered this in my previous course, which is the day trading course. If you haven't taken it, I suggest you do if you want to learn a little bit more about day trading. Knowing how to day trade can make you a lot of money when you take it into options trading. So if you want to look at option contracts through Robinhood, you can very much do so, because every platform provides the same exact options, because they're all given from, you know, the same place. So no brokerage account is going to give you different option contracts. They all have the same option contracts. It's up to you how you want to view them and where you want to view them. But another thing that I always do, for example, is I look at tradingview.com to analyze my stocks. I don't necessarily analyze them through my Thinkorswim, because I can navigate through TradingView a little bit better on my computer, better than, you know, TOS or Thinkorswim has to offer me. So it's really up to you. You guys can mix and match what you do. You don't have to go through, you know, a one specific trading platform to do everything. You can go on tradingview.com to analyze something and go execute through Thinkorswim or whatever option or whatever platform that you use and whatever brokerage that you choose. So anyways, back to option contracts. Remember that not all brokerage accounts will offer you options right away. Sometimes you have to go into the account and actually enable options trading. So after you've enabled options trading, you go into a stock. Let's say, for example, we go into Roku stock, and we want to trade Roku options. So we go into trade Roku options, and right away you're familiar with this page, I'm sure, you know, through the previous videos in this course. But right away at the top you see buy, sell, call, put, and then expiration. Let's go ahead and push expiration out till July 5th. That gives us about 20 days. Today is the 15th of the month. It's also a Saturday, therefore the market is not moving up and down. So one thing to note about that is when you pull up your Greeks, usually they're moving up and down. They're not moving dramatically unless there's a dramatic shift in the stock, but the Greeks are moving up and down as the market is live and moving up and down as well. So right away, we want to determine which options are in the money and out of the money. This option that I've clicked on is pretty much at the money. So these two options are pretty much at the money. Anything above is going to be out of the money, and anything below is in the money. We're going to be looking at call options and determining how much money you can possibly make for every dollar move that the stock makes. So currently the stock is at 102.05 cents. If we break down 102, this is the strike price. You are paying $505 for this contract alone. So if you pay $505, you want to know how much you can possibly make on this stock as it goes up and down. How much is this option going to be going up and down with it? Right away, as an experienced options trader, I wouldn't get into this because there's no volume and there's barely any open interest. It makes it a very hard stock to buy and sell away from. So once you enter the option contract, it's going to be pretty tough to get out as you're at your ask price. As you can see, it also has a large spread. So remember how we talked about volume having a lot to do with the bid and the ask. So there you go. There's a perfect example of it. But that's not our focus right now. We'll talk about what makes a good option contract in the next few chapters. For now, we're going to be talking about the Greeks and focusing on the Greeks. So if we want to determine how much can we possibly make for this stock as it moves up, because we have call options here, if it moves up to 103.05. So if the stock moves up to 103.05 and we have a call option, and it's this call option, it's this specific one, how much money are we going to make? The way you calculate that, as I stated in the PowerPoint, is you're going to take delta, which is 0.53, and you're going to multiply it by 100. And that gives you roughly $53. Well, it gives you $53, but it's roughly how much you're going to make. So you get $53. And so what you do in this case to determine how much your upside is or your downside, remember, for every, positive risk, there's a negative risk that goes with it. So if you bought at 505 and the stock moves up by $1 to 103.05, this is the stock's current price, and this is the the expected move. If you bought at 505 and then you add 53, you have just netted a profit of $53, and now you have $558. A contract that's worth $558. Sorry for the sloppy writing. I'm not using a mouse. I'm using my trackpad. So that gives you $558. However, if you had held this option overnight, say the stock didn't move to the 103.05 until the next day after you bought this option, are you still going to make $53? No. you're going to make $41. How did I come up with this number? The way I came up with this number is I multiplied delta by 100, which gave me $53. But then, because I held overnight, I had to multiply theta by 100 as well, which gives me $12 or negative $12, which equals $41. So really, if the stock had moved up to 103.05 the next day, I've already lost $12 through theta. Therefore, I actually only net a profit of 41. So theta is very important to keep in mind. If you are going to hold the contract overnight, you must look at theta. Let me show you an example of a high theta. That way you can see just how much it can hurt you to have an option contract with a high theta. Let's go to Amazon stock. If you have an Amazon stock and you have your expiration set for July 5th, let's wait for it to load. Oh, my internet is crappy right now. So if you have an option contract, a call option contract for Amazon expiring July 5th, look at how much these contracts cost. So if you're close to being in the money, your option contract is going to cost you a ton of money. So this is $4,400. Just keep that in mind. Look at its theta though. You have a theta of 1.08, which is dramatically high. You don't, unless you have a lot of money and you're leveraging options, which we'll talk about later on in the chapters, then you don't want to enter an options contract with such a high theta, because look, it even outweighs delta. So your best case scenario, the stock moves up $1, which Amazon usually moves up a few dollars every day. If it moves up $2, you'll make $104 plus the 0.003, but then you're gonna have to subtract theta right after it. So it really shows you just how bad theta can eat away at your profits. So stick to options that have a low theta if you're planning on holding overnight. And if you want to hold just for the day, buy and sell within the day, theta can, you can care less about theta. It's really more about delta and gamma in that case. So let's talk about what an options contract looks like when it's further away from the money. What do these Greeks look like? So if you go away from the money, let's say your strike price is going to be $21.40 when the share price is at $18.69. There's a very small chance that within 20 days, Amazon is going to move up to $21.40. Don't get me wrong, it can very much happen. You can get lucky and it moves all the way up to $21.40 or towards $21.40. However, you're not going to be making much until it gets pretty close to that range, and then the bid and the ask volume and open interest are also pretty low. So when you are looking at a stock price or a strike price that's way out of the money, then your deltas and your gammas start to decrease dramatically. As you can see here, even if the stock moves up $1, even if it moves up a whole dollar, you'll still only be making 1.02 in profit and losing about $8 in profit on your hold. So buying a cheap option is not always a good option, no pun intended. You want to be closer to being in the money, maybe not that much at the money, but at least to give you some kind of leeway on your delta, because this is a very small delta. It's not likely going to be achieving anything dramatic for you to increase that delta. Now remember, as the stock option, as the share price moves up, this delta also increases if you have a call option, but still it's not likely going to go up to the point in which you can profit a lot on it. Anyways, that was just a small breakdown of the Greeks on an actual trading platform. Every platform presents calls and puts and options differently, so you're going to see these same numbers, however they're going to be laid out differently. So the Greeks will always be available no matter what. Don't think that you're not supposed to see them. You can see them on any trading platform. It just changes based on the platform. Alright, so now that we've covered pretty much most of the basics in options and what determines option pricing, how much money can you make off of an option, how to determine the money you make, we're going to put it all together. So this is what I look at when I am trading an options contract. I'm going to be explaining the different things, and then I'm going to move into different examples of what I mean. So the question that's presented is, what makes a contract good? What makes it a good purchase? And then we're also going to talk about position sizing. So The first thing that makes a contract good would be the underlying stock. So obviously, before you trade a stock's option contract, you have to first study the stock's chart. If you know how to determine, where the next move is going to be in a stock or where you think is going to go, then obviously you'll be able to purchase options accordingly to that. So you must study the underlying stock. You have to see all the different factors are affecting it and impacting it at that very moment. The things that can impact it for the long term, if you plan on holding the option for a long term. How much volume is the stock seeing? Are the volumes of the stock parallel with the options volume, or is there more volume in the put options while the stock is going up? You have to determine all those things because they help you see if that option contract is good to go into or not. So it all starts with the actual stock. You don't look at the options first. You look at the stock, you look at all the different headlines surrounding the stock, you look at the graph, you look at its candlesticks, and see if it makes sense to go into that stock. So if you don't know how to, read underlying stock charts, then I suggest you go take our day trading course. Our day trading course runs you through all the different day trading aspects that are required for you to become a successful day trader. If you know how to day trade and you learn all about options, then you can use your day trading skills in options for profit. You'll make a lot more profit trading options, but you have a lot of a higher risk. So you have to know both sides professionally. If you don't know both sides professionally, I suggest that you sign up for a paper trading platform on Thinkorswim or something, because then you can at least practice before you jump into a stock and use your actual money. So that's the first thing that I look at. Obviously, I look at the underlying stock. What's popped up on my scanners? What's looking good? How is the overall market acting? Second thing to look at is the closeness to being in the money, at the money, or out of the money. In the money options are going to be most valuable. They're very reactive to stocks movements. At the money options are also very valuable and very reactive to stocks movements. So as the stock's price is closer to the strike price, you're going to see the option value fluctuate right when that price fluctuates. When you drift further out of the money, delta and gamma are going to be lower. Therefore, it can be very difficult to trade because you're not going to be moving up and down as the stock moves up and down, coincidentally. We'll, jump into an example that can really put this together for you. Implied volatility, I'll go ahead and give you a website example. I don't really have much to say on it here. I also look at the bid and the ask. So how tight is the spread? How are both sides reacting to the stock's movement? So far we're looking at underlying stock, closeness to being in the money, at the money, or out of the money, implied volatility, bid and the ask, and I also, of course, look at the Greeks. What is my upside and downside potential if I was to go into this stock? Delta and gamma would be the main ones for how much money I can make, and then theta is if I plan on holding the contract for a long period of time. Now, this is just what I would do. These are the things that I look at. Maybe other traders have a different way of doing things or different things to look at. I can't imagine so, but this is just what I do. By no means do you have to follow me to the T. This is just what I look at. These are the first things that I study when I look into trading options. So with that being said, let's go ahead and jump into an example. That way I can put all of this together for you and show you which options I would personally buy versus which options I would stay away from. So here I've pulled up Robinhood. I've already talked to you about Robinhood. You have your own choice of what brokerage you want to use. This is just very easy to read in terms of option contracts. So I read them on here and execute them somewhere else. If you want to continue using Robinhood, be my guest. I'm not going to tell you what to do with your life because at the end of the day, it all has the same numbers and goals. But if we pull up, let's say, for example, option contracts for Microsoft, and then we go into trade Microsoft options. First of all, I want to determine how is the market acting right now. Am I going to buy and sell within the same day? Obviously, I can't do that here because it's a Saturday. Or am I looking to hold Microsoft for a long time? Is it a good time for me to go in and hold Microsoft through July 12th? Let's go ahead and take a look at Microsoft in chart form. So I'm going to move over to tradingview.com and look up Microsoft. So obviously, as you can see, maybe a call option is not the best choice here. you could see that Microsoft is reaching an all-time high. Literally, it's never been this high in its history. So buying a call option here may be risky. It may be risky to go ahead and buy, a call option for a strike price of 135 because there's a chance, a huge chance that it's going to have a major pullback soon. That is with all stocks. Everything that goes up must come down, and it's better to wait for it to go down, buy low, sell high before you go in. So if you buy a call option on Microsoft now, it may not be the best choice. Let's compare call option volume to the open interest. So we have volume of 3,658 on the call side. Let's take a look at the puts and their volume. Now, actually, let's go ahead and move out a little bit before we do that. Let's go ahead and take a look at July 5th. Let's go ahead and take a look at the call option open interest versus the put option open interest. When we look at call option that's in the money or at the money here, there's only a volume of 193 and 687 open interest. Now remember, the market is reaching a high for Microsoft. Let's compare that to puts expiring the same date. If we look at in the money or at the money, there is a volume of 1,033 and an open interest of 207. Obviously, you can see that puts are more active. So that kind of can give you a clue to how the market sentiment is feeling about Microsoft specifically. There's more volume in put stocks than there is in call options. So that right off the bat, now I'm a little wary. Do I want to go in for a call when most volume is occurring in puts, or do I want to, just wait it out, or do I want to play a put? That's really determined by your own reading of the stock chart. I'm not going to get into charting. I'm not going to get into, any technical analysis because you should already know this if you're taking an options course. So we'll leave it at that. So when we're buying long-term options, in this case, let's go ahead and set the expiration date out for July 26th. When we're buying long-term options, we want to take a look at the implied volatility of the stock. So we go back to our ivolatility.com. We pulled up services and tools, analysis, option basics, and we already have pulled up Microsoft. I've typed in the symbol. Microsoft currently is reading at an index mean of 20%, 0.98, so 21%. That's relatively low because the 52-week low was 15% and the 52-week high was 44%. So we have a relatively low volatility marking in this stock. So it's better for us to go into low implied volatility when we're buying an option because then it can't hurt us as bad in the future if we're planning on holding for a while. Remember, if you're an option buyer, you don't want to hold a stock with a high implied volatility for a long period because it can very much chip away at your profits. So let's go ahead and go back to our Microsoft chart. So if we had a 21% implied volatility within the next year, remember, so it gives us 1 year implied volatility. We're going to take $132. Let's take $132 and we're going to multiply it by, let's just call it 20%. So we multiply it by 20%. What does that give us? I'm sorry, you're going to multiply it by 0.20 because we want to figure out the dollar amount. So we're going to multiply 132 times 0.20, and that gives us $26 roughly. So that means based on standard deviation within the next year, we have a range for Microsoft. And that range is $132 minus 26, which equals 106, and $132 plus 26, which equals 158. So now over the next year, over the entire year, there is an implied volatility that can move 68% of the time. The stock will move between these two numbers. So 68% of the time, the other outside would be 16% on each side. So that is really not a very high implied volatility. Therefore, it's a safe stock. However, it's important to do this because it really can give you a range. Like, how bad can it get? How high can it get? 68% of the time is a very large number. So you have a 70% chance almost that the stock will move up to 158 or down to 106. Now, the bad side, I guess, is you don't know which way it's going to go, where technical analysis and even some kind of, critical what is the word I'm looking for? Fundamental analysis is going to come through, and you're going to want to look at the actual numbers for Microsoft and see which way it can go based on your own reading, which is very subjective. But just to give you an idea of how to plot out that implied volatility. Now keep in mind there are indicators that will give you implied volatility. I just like to do it by hand just because. Anyway, so let's go ahead and clear this off. I just wanted to give you that example. That way you don't go in blindly, not knowing just how volatile the stock can be. But when you are looking at the volatility for Microsoft, it's not a very high volatility stock, which makes the option contract actually not a bad purchase, because had it been a lot more volatile, then maybe buying an option is not a good choice, because if Microsoft was sitting at a 40% volatility and compared to its highest point at 44%, that means as the stock moves forward, the volatility is likely to decrease. So your option premium will also decrease with it. So this goes for holding options long term. My strike price is at 132. The option pricing is $225, and then the bid and the ask, there's a 5-cent spread, which is fantastic. That's a beautiful spread. So when I buy this contract, I will bid at $2.22, so $222, wait for my order to get fulfilled, and then ask for something later on as the stock moves up in my direction. My volume and open interest are looking good, therefore there's a lot of liquidity. I know I can get in and out of this stock pretty easily. The Greeks are looking pretty strong. So I love these Greeks. $45 per dollar move is fantastic. So if Microsoft just drops by $1 while I'm holding this option tomorrow, let's say it drops by $1 tomorrow, the next trading day, then I will make $45 due to the fact that it dropped. I have a put on here. Delta is negative when it comes to puts. So I made $45 because it dropped by $1. So everything looks good on this options contract. I would definitely, buy, because knowing that the Microsoft is starting to top and it's likely going to reverse and have a pullback, so it may actually be a put option in which I take interest in. Now, determining how far out you wanna set your expiration is also very important, because you don't want to put an expiration on the 21st and then strike at 123, because then look at the differences in this option statistics. So now if your expiration is the 21st, today's the 15th, so if it's expiring in 6 days, your bid and ask are going to look a lot different. Yes, you still have a tight bid and ask. However, the Greeks are very low. So for every dollar, you're only going to make $3. It's really not worth it. Yes, you only pay $7 for that option, but is it really worth risking $7 for a $3 profit? Not really. You want to look for something that's going to bring you a little bit more, so maybe pay a little bit more of a premium. So even if you don't want to pay that much, let's say you want to pay $53, now you have a higher delta. So as you can see, it's a very small change. You went from 123 to 130 strike price. You're paying a little bit more, risking a little bit more, but your profit potential is now $24. But you must look at it from both sides. You have to see that your profit potential is 24, however your loss potential is also 24 per dollar move. So you gotta look at both sides, which leads us to our next point, which is going to be risk tolerance. So let's move back to the PowerPoint and talk a little bit about risk tolerance and risk management that you must take when you're trading options. So I've covered this in my day trading course, but I just want to cover it again in my options course, because position sizing is just as important in options as it is with stocks. It actually is more important because option prices move a lot faster, therefore you're at more risk. But generally, traders don't place more than 5% of their account in a trade. So if you're trading with $1,000, you don't want to place more than $50 of your account in that trade. You can also measure your risk tolerance, and I'll show you how to do so in Think or Swim when we get to chapter 7, which is very important because in the previous chapters, we've only talked about single leg options, but we're going to get into multi-leg strategies. Don't be freaked out. They're actually fairly simple the way we explain them, but Thinkorswim makes it pretty easy to read how much you can possibly lose on a trade and how much you can possibly profit. Now, when you're playing multi-leg options, you can actually see the specific amount that you can lose, and then you can allude it to the 3 or 5% that you're willing to lose on that specific trade. Now, if you're playing a single leg option, that means you only bought one call, you're not selling anything against it. That means you are risking the 5% on that one call. So if you wake up tomorrow and the stock drops dramatically, you will lose your entire 5%. So you got to ask yourself, am I holding the stock overnight or this option overnight, or am I going to be selling it in the same day? Therefore, you can calculate your risk tolerance accordingly to that, because you can amount for 3% losses within the same day because you can simply just sell the option when it hits negative 3%. But if you wake up tomorrow and the stock had dropped, it may have lost the entire 5%. So you got to ask that question. Now, I'm not going to get into the percentages too much or the amounts that you should be risking, only because I want to leave that up to you. But I'm just telling you, as a general rule, you don't want to risk more than 5%, maybe 7% of your account on a trade, because then you are just playing with too much money that you can't afford. If you lose 7% of your account, you already lost $70 of $1,000, putting you at $930. Now, as you slowly and organically grow your account, it will make more sense to why you can make more money from options, because if you have a $2,000 account and you're risking 5%, that's $100, and that $100 will likely generate you higher returns. So it's a slow process, guys, and that's one thing I want to tell you. If you plan on trading for a living, then remember that most people that work in their life, they work about 40 years and then they end up retiring. The stock market does the same thing. Now, you may have a higher potential of making more money in the stock market. However, most successful traders, they make money slowly every week. They don't make $1 million overnight unless they're working with a very large account, and it's a 1 in a million chance. You want to revert back to your plan. Ask yourself, why am I trading? You got to hold those emotions back from risking everything just for luck. You want to slowly build your account, because losses are 100% guaranteed in the stock market. You're going to take losses, and you don't want to take a loss when you're risking more than 5-10% of your account. And I also want to say that options move very quickly, as I mentioned earlier. Therefore, placing a large amount in one trade can literally end your account. I've seen it happen to plenty of people, so you have to be careful with the position. I know it's very enticing knowing how much money you can make from a single call option or a single put option, but you have to think critically, and you have to think about your plan and why you do this for a living. But anyways, guys, that brings me to the end of chapter 6. In chapter 7, we're going to be talking about option strategies, which is the bread and butter of your profit. And it's actually amazing the way you can calculate your P&L in Thinkorswim, because it'll literally give you a breakdown of the amount you could lose or make on this specific trade. So I'll see you guys in the next video. Hey guys, in chapter 7, we're going to talk about option strategies. This is by far my favorite chapter, and it's the most fun and engaging for you guys. The reason why is because we're going to start talking about multi-leg options and how to build specific option contracts for your favor, minimizing your risk and maximizing your profits. So far, in all the previous chapters, we've only talked about single leg options, which means that you've only talked about, or you've only seen me talk about, buying calls or buying puts, or selling calls and selling puts. Now, with chapter 7, we're going to present to you how to buy and sell, or buy two different positions at the same time. That way you create a strategy in which can maximize your profits and put you at less of a risk for losing money. Option strategies are the most popular way to make money on the stock market, and these option strategies are the most popular way to sustain profitability. I'm going to be covering the most popular option strategies and the things that have worked for me personally. Feel free to go ahead and do the same for yourself. You guys can actually feel free to research and discover more option strategies for yourself in the future, but I'm going to be covering the ones that have been most profitable for myself and most sustainable. So without further ado, let's go ahead and get started. Hey guys, in chapter 7, we're going to be talking about option strategies. Option strategies can be very Hey guys, Hey guys, Q again from Ayanti Trading. In chapter 7, which is my favorite chapter, we're going to be talking about option strategies. Now, option strategies consist of buying and selling and buying two different positions for you to act. Hey guys, Q again from Ayanti Trading. In this chapter, which is chapter 7 and your final chapter, we're going to be talking about option strategies. Option strategies are very popular amongst option traders, and the ones I'm going to be showing you are the most popular and the ones that I've used personally for profit. Now, everything that we've talked about in the previous chapter has only consisted of buying a call or selling a single call or buying a put or selling a single put. In chapter 7, we're going to introduce strategies that will allow you to maximize your profits and minimize your losses by buying or selling two different positions at the same time. You'll see what I mean when I get into this chapter, but bear with me. This is going to be our hardest chapter and it takes a lot of trial and error. Before I begin this chapter, I do recommend, if you don't have a paper trading account, I recommend that you download Thinkorswim. It's completely free. You can actually just switch right over to paper trading and you can build things with me. That way you can see how they work for yourself, because that's the best way to learn. So without further ado, let's go ahead and get started. So the first thing I want to cover in this chapter are going to be option spreads. Let me read the PowerPoint, and then as we go on through the examples, you're going to learn more and more about spreads and why they're useful. So how do you profit from option spreads? They have multiple ways in which you can profit from them. If the stock price changes to a favorable position, then you will make profit out of that trade as long as it goes towards the position that you had initially predicted. Even if the price of the stock goes to an unfavorable price, you can still make money. We'll talk about how you do that in the later parts of this chapter. Time decay is also very profitable for you as an option seller. So we talked earlier about time decay working against you, but when we're selling options, which we'll show you how to do in this chapter, then you'll be collecting a credit. And as long as time goes on and the stock is moving away from the predicted move, then you will be making money. Don't worry about that too much. It will make more sense as we go through the chapter. Implied volatility. When you're doing spreads, implied volatility kind of evens itself out because you will be buying and selling options against each other. Therefore, it reduces the effects of implied volatility, which can actually work in your favor. Let's talk about some of the upsides and the downsides when you're doing spreads. The upside is that you limit your risk. So you don't spend as much money into the options and buying those options, because then you are betting options against each other through the spread. Like I said, it'll make more sense as we go through some examples. It's usually a cheaper trade, so if you have a small account, which is the next point, this is perfect for you. Trading spreads allows you to trade good options with less money. Now let's talk about a little bit of the downsides. With the downside, you are in risk of being assigned the short option if carried through expiration. So if you carry the option through expiration and the stock surpasses that point, then you can get assigned that option contract and you'd have to pretty much give away 100 shares of the stock. Now don't worry too much, because as long as you're selling before the expiration at a reasonable time, then it's very unlikely that you're going to get hit with a contract execution. So as long as you're selling maybe a week before expiration, you're likely to be in good hands, unless the stock is way deep into that strike price. Then you'd want to get out of it as soon as possible. That'll make more sense in the later parts. Also, the downside is that you limit your profit potential. So because you're limiting your risk, you always have to limit your profit potential, but you'll see it actually makes a lot of sense if you want to have long-term achievable income from the stock market. So all this is pretty much just vocabulary for now. Don't worry about it too much. As we go through the examples, you'll see exactly what I'm talking about, but these are just some notes that you should jot down and refer back to as we go through the different strategies that we're about to talk about. So let's go ahead and start with the first strategy. In the first strategy, we're not going to be talking about a spread just yet, because we want to compare the normal long call versus the long call spread. So if you just purchase a normal long call, This is the most simple option you can buy. You're taking a bullish position with unlimited profit potential. So as long as the stock keeps going up, you'll be making money. Your risk is time decay, so you'll lose money on time decay. And it's also has a limited risk. So your risk in this case is going to be however much you paid for the call. Usually calls that are valuable, you're going to pay a good amount for them. So the long call for a small account may not make a lot of sense unless you're feeling very bullish about the stock. Now people may look at this and they want to buy the long call alone because they think that they can make as much profit as possible. But the way I like to put it is the stock market virtually has unlimited profit that you can make on a daily basis. So why increase your risk for just one trade while you can limit your risk for just that one trade but still have the ability to make money every day as you go with a smaller risk? Remember, you're always playing defense and offense on the stock market side. And when you're playing defense, that's when you start winning more and more because you're minimizing your risk. So long call is something you should be familiar with by now. We've already gone over long calls. It's just normal call that you're feeling bullish about the stock and you're expecting the stock to go up by a certain date. So when you're comparing the long call versus the long call spread, the only thing that differs is that you're buying a call still. However, at the same time, you're going to be selling a call at a higher strike price at the same expiration date. And so what this does is it limits the amount of money that you have to put up front, and it minimizes your risk to that same amount. So you don't have to pay as much for a long call because some calls may be very expensive for somebody with a small account. Here, what you could do is you buy a call and sell a call at a higher strike price, and you limit the amount that you pay up front. What this does, both upside and downside, on the upside, you're going to be minimizing your risk, so it's a lower amount of risk, but you're also maximizing your profit potential versus having unlimited profit potential. But as I stated, we're playing defense more than we're playing offense when we're playing against the stock market because it's designed to make you lose. And so if you figure out how to play both sides, just like you do in a basketball game, then that's how you become an all-star player. So you want to make sure that you have strategies that don't allow your profit potential to be as high as it usually would. So this is a great option, no pun intended, for you to limit that risk potential, and it will make more sense as we jump into the example. All right, so in the first example, we're going to compare a standard long call versus a long call spread. So with a standard long call, here's the scenario. This stock, you initially found it at $29. You set out an expiration, and by the time that expiration hit, the stock had reached $31. You had originally bought a long call with a strike of $27. So bear with me. Let's go over that again. You bought a strike price at $27. The stock was already at $29. And so you were in the money when you bought that long call. You paid $3.85 for that contract, or $385 because you multiply that by 100. Your break-even point, the way you calculate that is you're going to add 3.85 to the strike price. So that equals $30.85. So if at expiration the stock is at $30.85, so at expiration, when the day comes, your break-even point is $30.85. So you need the stock to move up $1.85. That way you can literally lose zero and gain zero on your stock. So at that point, you're only breaking even. You haven't made any money. The amount you paid for that option was $385, as I stated earlier. Your max profit in this case is going to be unlimited. So say the stock doesn't close at 31. Let's say that we still have a while from expiration. You have an unlimited max profit as long as the stock keeps going up. However, your max loss, if the stock closes anywhere below $3.85 or $30.85, your max loss is going to incur and you're going to lose $385. Now, comparing that to a long call spread. When we compare it to the long call spread, this is the same scenario. The stock closes at $31 at expiration. The stock's initial price was $29 when you first discovered it. Here what you did was you bought a long call at a strike of 27, so the same exact call that you had bought earlier, and you paid $385 for it. But at the same time and the same expiration date, you sold a call for a strike price of 31. So a higher strike price that's out of the money. So your first strike was in the money, your second strike was out of the money, and you had gotten a credit of $1.89 for that one. So remember, when you're selling a call, you get a credit, you don't pay for it. And so here's what you end up paying for this. You take $3.85, this is negative, and you add it to 1.89, which is the short call, and you get a total of 1.96 or $196. That's how much you end up paying for the entire trade. Let's compare that to the first standard long call. Here you paid $385. So with a small account, you can definitely see how this is already helping you, but it doesn't stop there. So in this example, your break-even point is going to be less than the standard long call break-even point. Remember, we had said that the stock needs to make it all the way to $30.85 in this example. Here, you only need the stock to go up to your long call strike price, which is going to be 27. That's how much you paid for your long call. That's how much the strike price, was, plus the net debit paid, which was 1.96. So that puts you at a break-even price of $28.96. So as you can see, with a vertical spread, you're going to be needing a lower break-even price before you start making money, which everybody loves. Why would you want the stock to go up even higher before you start making money? So that leaves us with two questions. What is our max loss and what is our max profit? Our max loss is the price that we paid initially. So it's the 3.85 minus the 1.89. So that's our max profit. Let's say the stock doesn't end up closing near that high and it actually goes down. Then we end up losing $196 if the stock closes up below that strike price. So that would be our max loss. However, our max profit in this case is going to be calculated by subtracting the two strike prices. So the width between the strike prices, in this case, it's going to be 31 minus 27 minus 1.96, which is the amount that we paid initially, which gives us a total of 2.04 or $204. So if the stock goes above this point right over here or close to it, at expiration we'll collect a total of $204. Now, not to worry too much, all these numbers are going to be automatically calculated for you on your brokerage platform. I'm just going through them because I want to show you how it looks visually through human calculation before we jump into an actual platform and talk about it. And so, as you can see, as I stated earlier, you're minimizing your potential to lose. So you're only going to be losing 196. Worst case scenario, but you would be gaining 204 if the stock does what you expected it to do, and it doesn't even have to make that strong of a bullish move for you to start profiting money. So you don't have to hold this until expiration. You can get rid of this as soon as you want. As soon as you see profit, you can sell it. If you sell it in the same day, it counts as a day trade. If you sell it a day later, you can it doesn't count as a day trade, and you can still collect profits. Even if you're losing money, you can sell it and take that small loss. You don't have to wait until the full profit is realized or the full loss is realized. Now, keep in mind, as I stated, anywhere above this point, holding the long call spread is going to be risky for you, because if the stock goes above 31, remember, you're selling a call at 31, so somebody on the other side can actually exercise their option and you owe them 100 shares, which is exactly why I don't hold near the point of expiration. I always leave earlier and I take my profits and walk away. Again, if you hold past the 31, at any point, somebody can choose to exercise their option, and you have to pay them. You're obligated, because you're selling a call. You're obligated to give them 100 shares. So let's compare the profit potential between the long call spread and the standard long call at expiration if the stock expired at 31. So with the standard long call, if the stock expired at 31, then you would only be making 15 bucks. The way you calculate that is you take your break even and you're going to subtract that from the point at expiration. So whatever the stock expired at, you're going to subtract 31 from 30.85, and you only end up making $15 on this long call if held till expiration. So as you can see, you risked a lot more for a small gain. Comparing that to the long call spread, if the stock closed at 31, you'd actually end up collecting $204. The way you calculate that, as I stated, is you're going to take the width of your spreads minus the initial amount you paid, and that gives you a total of $204. So there you go. There's a huge difference between your P&L. What would you rather risk? Would you rather risk 385 for an option to make $15 if the stock expired at 31, or would you rather play your odds a little bit better and make more money, however risk less? So there you go. There's the pivot point between your decision, and for you to profit on the stock market, you need to make decisions like this wisely. That way you limit your risk. Here you're risking a lot more. You're risking 385 versus here you're risking a lot less, which is 196. And you can play around with the numbers, guys. This is just a standard example I'm showing you. I'm going to be showing you multiple examples on my actual trading platform in just a second. But just so you know, long call spreads are going to be riskier because you have the bottom line is higher. The amount that you could lose is going to be higher, which is what we're going to talk about in scenario 2. This is if the stock does not make it to $31 at expiration. So in scenario 2, we're going to be comparing the standard long call versus the long call spread if the stock closes at $29. So first we showed you what happens if the stock closes at the higher strike price, which was 31. Now we're going to show you what happens if the stock closes at $29 at expiration date. So remember, the initial stock price when you first purchased your long call on a standard long call was $29 and you bought a strike for $27. If the stock closes at $29, now you have to do the calculation, and your brokerage does this for you automatically. I just want to show you how it's done by hand. You're going to subtract $29 minus 27, and that's because there are 2 points between the stock's initial price and the strike price. So what it had come to versus the strike price, which was 27, and that gives you 2.0. So now your call is only worth $200. Remember, don't be too confused by this, you guys. So there's the initial price that you saw it at, and this is where the stock closed. So you take the closing price and you subtract the strike price of your call from it. That gives you 2.0. So now your call is only worth positive $200, and you lost $185 on this trade. And this is on a standard long call if the stock closes at $29. So it doesn't make it past that break-even point. You lost $185 on this trade. Now to compare that to the long call spread, you already lost 185 as we talked about earlier, right over here. We're going to write that out. Sorry for my horrible handwriting. 185, so you're negative 185. However, with the short call, considering you sold this and the strike point was never achieved, you gained $189 out of this. So you're positive 189. Therefore, you actually end up making $4. Usually it actually cancels out, but the strikes on this specific stock were a little weird. But usually you'd end up at zero, so you don't make money or you don't lose money on this specific trade. So you can definitely tell now that we're starting to see a lot more benefits between just a standard long call versus a long call spread. Here you ended up losing $185, only getting $200 back. Here you ended up breaking even. I'm sorry, here you ended up losing $185, and here you ended up actually breaking even. So another benefit of having a long call spread is even if the stock doesn't go as high as you expected it to, you're still, you almost have insurance if the stock closes below that strike price. So in scenario 3, we're going to pretend that we were completely wrong about the stock price direction, and it actually ends up closing somewhere down here at $20. What would happen to your standard long call versus what would happen to your long call spread? So we're going to start off with the standard long call. Remember, this is the same exact stock. Nothing has changed. Your strikes are still the same. And so in scenario 3, the stock closes at $20. You would lose your entire $385 because the stock didn't even make it to the breaking even point. So you'd lose the entire $3.85 that you paid. That results in a 100% loss. So you lose 100% of what you paid because you only did a standard long call. Therefore, you put yourself at max risk. Now, if we compare that to the long call spread, then that would put you at, let's see, you lose 385 here, so this goes away. However, you gain 1.89. So you are going to be losing $385, but you're going to be gaining 189. So you subtract 189 from from 385, and that puts you at a grand loss of 196. As we stated earlier, the amount that you lose is the amount that you paid. That's the max amount that you could lose. So you only lose $196 versus losing your entire strike or long call strike if you had just bought a single strike call. So again, there's another example to why it's so beneficial to have a long call spread. That way you almost buy yourself insurance, as I stated earlier, to lose less money if things went the wrong direction. So now that I've walked you through 3 different scenarios of what would happen if you had a long call spread versus just a standard long call, we're going to jump into my Thinkorswim platform where I'll show you an example and show you how you don't even need to make all these calculations that we went through. It's actually all drawn out for you depending on the brokerage platform you use. Thinkorswim just happens to be my favorite when I'm playing any type of option strategies, and you will see why in just a moment. So what I have pulled up in front of you is a simulated trading account that's based out of TD Ameritrade's Thinkorswim platform. Now, Thinkorswim, as I stated in my day trading course, is a completely free platform that you can use, and it offers you a paper money account that you can practice with. It's fantastic for beginners. I know it looks a little overwhelming, but it's actually pretty simple once you get the hang of it. When I'm building option strategies, this is my go-to. I'm not obviously on my actual account right now. I'm in my simulated account. Simulated accounts are something that you should be practicing on first before you jump into actual money trading. It's pretty much like Monopoly money, and it allows you to pretty much mess up, learn new techniques, practice these strategies. That way you don't end up losing your own money if you did something wrong or if you're not getting something right away. So let me explain what I'm seeing in front of me just real quick. I have pulled up AMD, which is in the top left corner where my cursor is. And this is the stock that we've been doing examples on in the past scenarios. So what I'm going to do is I'm going to look at its option chain. This is its option chain right over here, and I have it pulled up under Analyze, and I went to Simulated Trades. Okay, so if you actually want to trade, you have to go under Trade. If you want to go to just pretty much Simulated Trades, which where you can pretty much see the risk profile. I'll show you why that's important in just a second, but I'm under Analyze and I'm under Simulated Trades. And so I have the option chain in front of me. As you can see, there are multiple expirations. These are the weeklies and these are the monthlies. So I'm going to pull up August 16th, which is 55 days away. So this expires 55 days away. Right away, you can tell that there are calls on the left and there are puts on the right, just like any other brokerage would place them. In the middle, you see that there's a total of 10 strikes. You can change that to 8. You can change it back up to 10. It's really up to you. Under there, you can see the last trading price, the net change, the bid, and the ask. So this is really up to you how you want to set it up. This is just the way I have it set it up for my simulated account currently. But without further ado, I'm going to go ahead and jump into an example of what a vertical spread looks like. So everything we've been talking about in the past scenarios, this is how you create it on Thinkorswim. The stock, like we said earlier, is trading at $29.10. We didn't account for the 10 cents earlier to make it easier for the numbers. However, what we did in the examples was we had bought the $385 call. So we bought the call, okay? So this was the strike price of $27. So this is in the money because the stock is currently at 29. So you buy an in the money call, which is 385. So you just simply click right under where it says ask. So bid and ask. If you click under any numbers under ask, then you're buying the call. However, if you click under bid, then you're selling that call, meaning you're shorting that position. So what you want to do is you want to hit $3.85, and then you're going to hold control. I have a MacBook. I'm not sure if it's the same for other computers. You're going to hold control and you're going to sell the higher strike price. So in the example we showed earlier, our strike price was 31. And so we're going to sell that 189 by holding control and clicking on it. And so at the bottom of the screen, you can see that automatically on the left side, it recognizes that you're doing a vertical spread. Now with the sides, you're buying a call option and you're selling, it automatically defaults to 10 options. So you want to bring that down to 1 or as many as you really want to trade. But I'm just doing this for this example. The stock is AMD. The expirations are the same because you're doing a spread. These are the strike prices. So there's 5 points in between them. You're doing 2 calls and the price that you're paying is 1.90. Now in the example we did 1.96, which was the amount at the highest ask. So that was 1.96, and then the other ones are delta, and we won't really get into that. But so why am I showing you this? Why is this important? It's because you don't have to do all the calculations that we did earlier. If you simply click on risk profile, then this is what comes up. Now you have a vertical spread that you have already put onto your Thinkorswim platform, and it calculates the max profit and the max loss for you. As I drag my cursor back and forth through the screen, when I go to the left side, as you can see on the bottom left, our total loss is accumulated to $196 in that blue font. As just like we calculated earlier, it's already calculating it for us. It makes it super easy. Now our max gain is $204, which is right at the top where I'm pointing out with my cursor. So as you can see, this is very simple, and it even gives you your break-even point. So at break-even at $28.95, you're going to be making $0. It's pretty much zero. So this is a really cool way and fun way. That way you can maximize your max profit and max loss potentials. If you actually do go under trade and you select those options one more time, so buy and then hold control and sell, when you hit confirm and send, now I'm gonna put that price up, that way you can see. When you hit confirm and send, then it gives you, I'm sorry, let me bring those options down. I told you it defaults to 10. When you hit confirm and send, then you can see your max profit is laid out right in front of you, and your max loss is $196. So it's an amazing way that it already calculates everything for you. So there's no excuse to complain that you don't know how to, calculate your max loss in some cases, because if you just go into a professional trading platform, as you should if you're creating option strategies, then you will see that it does everything for you. All you have to do is take the right position. So you can kind of mess around with the different option contracts as long as you're buying the more in the money call and selling the out of the money put. No matter which one, it's going to create and generate different numbers. Let's say we bought a call that's further deeper in the money, and then we sold a call that's further out of the money. Let's see what those results are. If we confirm and send, see, your max profit is automatically calculated at 382, and your max loss is 318 in this case. Is it really worth it? Do I want to risk $318? That's something you really got to ask yourself depending on your account size. But even if you take this and you delete it and then you go back to analyze, add simulated trades, then you'll be able to create and mess around with the different call options and put options as much as you can. Now let's go ahead and delete this vertical spread and show you what it looks like when you're buying a single call option. Let's just buy the standard call option at 385 without any spread. It will automatically tell you that you're on a single leg. So when you're buying one call option, it's a single leg. Any other strategy would be multi-leg. And so let's go ahead and take a look at the risk profile in this case. Your max risk that you can incur is $385, which is what you paid. But as you can see, your profit potential is virtually unlimited as long as the stock keeps going up. But remember, there's always that expiration date that is working against you. Time decay is not in your favor. So I just wanted to show you how this looks on the actual Thinkorswim platform. If you guys have any questions about the vertical spread or anything like that, go ahead and reach out to us at ayantitrading@gmail.com, or if you have our contact through Instagram or YouTube. We're available on all channels. Go ahead and follow us, and you even have access to the group chat. So make sure you put your questions in there. That way nobody's confused. And that way we're making sure that you're making the most out of this program that you had invested in. So anyways, this is the end of scenario number 1 for vertical spread. We're going to move into a different strategy in the next slide. It's still the same chapter, but we'll be moving into another strategy. So I'm going to end this video here, and I'll see you guys in the next video. Alright, so the next strategy we're going to go over is a bullish strategy that you can use when you're feeling like the stock is going to go up. However, you want to protect yourself just in case the stock does fall a little bit short of your expectations for it. So the put credit spread or the bull put spread, that's what people call it. Either or works. The put credit spread, as I call it, is a strategy that consists of selling one in the money put option and you're buying an out of the money put with a lower strike price. So the option that you're going to sell, the put option you're going to sell, is going to be deeper in the money than the one you're going to buy. The reason why is because here you're trying to collect a credit. So like we said earlier, when you're selling a put option or when you're selling a call option, you're collecting a credit from a buyer on the other side. Therefore, if things don't go accordingly to what the buyer wants to happen, you get to keep that credit. So in this case, when you're selling that in the money put option, what your end goal here becomes is for the stock to close at a price above the in the money put option, because you don't want the buyer to be able to exercise that option. You don't want them to actually make use of their option. You want their option to expire worthless. That way you collect the full credit spread only if the stock closes above that in the money put option strike price. And that'll make a little bit more sense as we jump into an example. Now, as far as, the risk calculation goes, I'm not going to show you how to calculate it again. I think we've already spent enough time on the first part of the chapter learning how to make the calculations. It's pretty much the same formulas. And it's something that thinkorswim already and more brokerage platforms already calculate for you once you actually design the spread in the platform, which actually leads me to my next point. We're going to go ahead and jump into an example on thinkorswim. That way I can show you what it looks like trading it live on a chart. Alright guys, so what I've pulled up here is my thinkorswim platform, and I have it on for simulated trading. Here I've went under analyze and I went under simulated trades. So I've added a simulated trade, and I'm going to delete this down here, that way we can start fresh. And I've pulled up stock AMD. Let's say that out of the technical analysis that I've done, I expect AMD to jump up by August 16th, 2019. I'm confident that it'll go to at least $33, but I'm not confident enough to risk $510 for that. So what I want to do is I want to put a little bit of, insurance on my trade. So instead of just selling the put alone, I'm going to sell the put that's in the money for $510. So I would be collecting a $510 credit. However, I would be risking that much. And then I'm going to buy an out of the money put. So sell a higher in the money put and buy an out of the money put. So I'm going to buy this $207 put, and that puts us at, let me go ahead and drop this down to 1. That puts us at a risk profile of a maximum gain of $302 and a maximum loss of $198. And if you drag your cursor across the screen, or as I'm doing with mine, you can actually see the exact breaking point at $29.99, or around that area. I can't get it spot on, but the stock can go all the way up to $29.98, or the stock can stay below $29.98, and I will lose $0 on this trade. Now, if the stock goes anywhere above that area at expiration, I will get to make money. I will get to keep a part of that credit that I collected by selling that put. So anything above $29.99, or let's call it $30, I will be collecting money, and I can collect my max profit at $23.31. So that's the cool part about this, guys. You get to play around with this. You need to, go in there and mess around, see the different things that work for you. But the basics of every spread are pretty simple. You're just selling something and buying something against it, or vice versa. That way you can kind of collect some insurance for your trades and risking less money while doing so. And so that was just a brief example of a put credit spread. It's not too difficult to understand. As you start to trial and error on your own, hopefully on a paper trading account, you start to get the hang of it. So I'm going to go ahead and jump into our next option strategy. We'll go ahead and see you guys in the next video.